was, he's a hero of mine. So it was pretty cool, for a young guy to be involved in all that.
Yeah, yeah, that's a very cool story, man. And can we find any videos of your stand-up acts online anywhere? Do they exist?
Oh God, no.
No, no.
I
Okay.
had a few up there, talking about, my humor back then was, just about getting drunk and fart jokes and, not having and trying to get laid and all that stuff. Now I'm going back on stage. Actually, just went on stage about a week ago, did more of the family structure and, just ripping into my kids. And, it's always shocking when, a father starts ripping their kids on stage and people were having a ball. And it was a good 6 minutes, 7 minutes. Everybody was laughing. And, I came off the stage and somebody said, you know what? You're like a weird Louis C.K. And I was like, sure, I'll take that. I'll take that all the way to the bank. I'll be the weird Louis C.K. any day. So that's my new thing now. I guess I'm the weird Louis C.K. And I'm a more of a storyteller, and like I said, I do some silly voices, and I'm very animated up on stage. So I have a ball up there, and now 15 years later from when I was up there, now I have no fear whatsoever. And you think being a trader is hard? Imagine getting up on stage all by yourself with the light blasting in your face, and everybody's waiting for you to be funny. Within 30 seconds, these people either like you or they hate you. There's no middle ground. And it's a rough business. It's a rough business.
Yeah, I don't doubt that at all. I mean, I imagine the crowds can be very savage. Just making a presumption here, I presume most comics don't find themselves becoming traders. What appealed to you about this, and how'd you get into it?
Well, I always liked the market. I had a math teacher in the fifth grade, and he did a stock market project where we had to do some research and track our stocks, and it was more fundamental analysis. Obviously, we didn't know anything about charting, and back in the day, especially me in the fifth grade. But ever since that time, I was interested in the market. But the silly part about this was I was doing stand up comedy one night, and some guy rolled up to me after the show wearing a suit, and nobody was ever wearing suits at a comedy club. So I'm thinking this guy might be somebody. Maybe he's an agent. Turned out to be a stockbroker. He's like, you're a funny guy. Why don't you use your sense of humor to try to sell stocks and make some money? Because you're probably not going to make any money being a stand-up. And I was like, well, that's kind of a backhanded compliment, but yeah, sure, man. I'll come out. Where is it? It's out in Long Island. And the name of the firm was like something Wall Street or something that sounded like some real firm. And next thing you know, I'm out there in Long Island, and I wasn't there for more than maybe a half an hour. Guy handed me a script. He's like, here's a list of 300 phone numbers. Call these people and ask me if they like the stock market. Give them a little bit of idea of what we're selling, and if they're interested, yell for me, and I'll come run and get the phone and try to make them some money, and I'll pay you if they close the deal. And it was just a the movie Boiler Room, Wolf of Wall Street. It was right there, but this place was so shady, and I was very unhappy within a week because it wasn't for me. I could see right away I didn't fit in. But somebody came up to me and he said, you look like you're kind of lost here. We're going to open up our own firm on Wall Street. You'll take your Series 7. We're going to be doing IPOs. And the first thing I said was, what's an IPO? And he's laughing. And I'm like, yeah, buddy, I have no idea about this business, man. If you're willing to teach me, I'm willing to learn. What's a Series 7? And next thing you know, it's probably the first time since college I went 30 days without smoking weed because I was like, I gotta clean up. I gotta take a test and get a job. This is serious stuff. And then I took my Series 7. I got a 93 on the Series 7. And I come in all proud, and I'm thinking everyone's going to throw me like a parade. First thing the guy says to me, the manager says, "Man, you're probably not going to make it in this business." I was like, what? I just busted my ass to get a 93 on this test, and this guy's already telling me I'm going to fail. Because it really turns out that it was the knucklehead, high-pressured salesmen that were making all the money in this business. Someone who knew stuff and was, I guess, educated. And if you couldn't sell, you were nobody in this guy's eyes. And I was, I was shown the light that I really was just a nobody at this place. And, I did what I had to do, but it was just, it wasn't for me.
Right, right. So just backing up a little bit, you said that there was the stockbroker who was in the comedy club. What was he doing there? Was he actually like poaching comics to come on board at the firm?
He just happened to be there. It was he was with a friend, and they just rolled up to me at the end of the show, and I guess they propositioned me. They told me they'd give me, I think it was $400 a week, which doesn't sound like a lot of money, but when you're a young guy, I was like, yeah, sure, I'll come out to Long Island. You're gonna pay me cash? All right, I'll see what this is all about. And that place I was only for, it was maybe a week. And if you remember this, I don't know, you're from Australia, but back in the day in Brooklyn, people thought it would be cool to put neon lights, like these kind of like halogen neon lights underneath their car and to like make the bottom of their car glow. That's what we were selling. That was the company. And my God, what a junk company. I mean, most of these companies that, I jumped from that firm to the next firm to the next firm. It turns out that most of these companies weren't even real. And that's really when I started realizing that this is the most shady business I've ever come across ever. Because we were pitching a company, let's call it Consolidated Incorporated, whatever it was. And it was supposed to be some huge corporation out in Colorado. And the next thing you know, I'm hearing them answering the phones in a back room of the firm as Consolidated Technologies. So I was like, wait a second, isn't this company supposed to be out in Colorado somewhere? Shut up, get out of the room, close the door behind you. You didn't hear anything. And I was like, okay. And, another really glaring moment of my, brokerage career came when they would do all these dog and pony shows. They'd come in, and I remember there was a retractable syringe company for dentists. The Novocaine was on the top of the needle. The needle would retract into this thing, so you wouldn't have to call the waste disposal unit, and you could deposit the syringe anywhere you wanted in a regular garbage. Genius concept, awesome concept. $5 IPO. It was going to go to $50 according to these guys. We had the scientists there, dentists there. We had this whole great show. So the day we start pitching the IPO, I get called into the office because I'm still a new guy. And so after all this stuff, they're telling me how awesome this stock's going to be. Kenny, don't put any of your friends or your family into the stock. What? You just told me it's going from 5 to 50. I'm about to buy 10,000 shares with my dad. Don't put your friends and family into the stock. So here's one guy, they're throwing a parade and, streamers and dog and pony show telling us this is the greatest stock in the world, but don't put your friends or your family into the stock. And I was like, all right, this is getting a little bit out of control now. So, there was a couple more shady things that happened. And I finally said, you know what, this isn't for me. But at that point, I had learned enough concepts where I thought maybe I could do this for myself. And coincidentally, 1992, 1993, the day trading didn't really take root until SOS. So I just was learning a little bit about charts. And then coincidentally about, I guess it was a year later, 1997, 1998, really, a friend of mine was opening up his own firm. He explained to me what this SOS trading was all about. And there I went, took my bar mitzvah money, plopped it into an account, and off I went.
Right. Okay. So just before we get into more about your actual trading, I'm still really interested by this this broker story. So how did you actually convince someone to buy stock? Like, what tactics would you use, and how successful were you at actually closing people on the phone?
Aaron, how are you? Kenny Glick from Patterson Travis. Listen, I'm not calling you with any specific ideas right now. I got your name from a high roller investor list that we purchased. I just wanted to know if I had an idea over the next couple of weeks, would you be interested in hearing about it?
Sure.
Okay, great. Well, listen, like I said, I wasn't calling you with any ideas right now. What we're going to do over the next couple of weeks, our traders and the owners of our company are researching some breakthrough scientific research company that might be an incredible opportunity for you. So what I want to do is in a couple of weeks, I'm going to call you back. I'm going to give you a kind of a heads up of what that company's all about. And if it's something that you're interested in, then we're probably going to try to secure a block of stock. Now, you probably know about the market. You know there's a bid and there's an offer. What we try to do is we try to get the stock in between the bid and the offer so we can offer you a discount on that stock. So when you buy it, you're actually ahead of the game. So when I do call you and I give you this information, you're probably going to have to make a snap decision. Is that something that you might be able to do? You know, if I give you a call, you'll be able to make a decision within a couple of minutes because I'm going to be really busy that day, Aaron.
That's hilarious. Like, how many times did you do this each day?
I would try to make 300 phone calls a day. Oh, that was what was, my manager would make me do. And out of those 300, you'd get about 15 or 20 people that were legitimately interested in hearing back from you. And then would come the buttering up situation. And I'd call, Aaron, it's Kenny again. How are you? I told you I'd call you. Listen, I don't want to bother you, and I'm kind of busy right now, but let me tell you a little bit about this company. And I would talk about the retractable syringe. And then came the third call close. Aaron, it's Kenny. Listen, we got that block I was talking about. The stock's trading right now at 550. I secured a block at 485. I could put you in there, but I can only get you 1,000 shares at that price. Is that something you might be able to do? 1,000 shares at 485? Tell me right now, because I can only get about 10,000 right now at 485. I could get you 1,000. That's about it. You're good? All right. You're in for 1,000 shares. Let me transfer you over to my secretary. She'll get your information. Welcome aboard, Aaron. Hopefully this is the beginning of a beautiful relationship. Thanks a lot.
And how many of your clients actually made money?
2.
Out of what, hundreds of thousands?
I probably had a book of about 80 to 100 people, which was pretty good. I only did it for maybe 18 months. And, some trades were, let me tell you, the reason that the clients that made money was once I started trading my own account and buying my own stocks, I started pitching the stocks that I liked. And this was one of those glaring moments that I was talking about. So, I just got back from Vegas. I was just turning 21 or 22 at the time. And I noticed every slot machine was made by one company, IGT, International Game Technology. I bought 1,000 shares. I got my dad into a couple of thousand shares. And it was like a $22 stock. Thing was rocking and rolling, 25, 27, 30. So I'm calling my clients, some of the IPOs hadn't tanked yet. Some of their stocks weren't at zero at this point. So we still had a decent relationship. And I talked to them about IGT. And, I had one guy, he's like, you know what? I'm totally with you. They're opening up a casino, a couple of blocks from, not a couple of miles down the road, the Indian reservation, and whatever you're saying, I'm into it. $22, I'll buy 5,000 shares. I almost vomited because here I am, opening accounts for, 4,000, 8,000. This guy wants to buy 5,000 shares of a $20 stock. So I'm freaking out a little bit. I don't even know what to do. So I'm okay, that's great. So I roll into the office and I'm sweating, but I'm extremely happy because I'm going to, open this guy for $100,000 trade. And, the guy puts his arm around me and he said, listen, Kenny, we hear you pitching this IGT. We really want you to pitch the house stocks, but that's a fantastic trade. On that $100,000 order, we're going to give you about $250 commission, which we're going to take half of. And after SEC fees and NASDAQ fees and some other fees, you're going to walk away with $80. If you take that $100,000 and put it into Consolidated Technologies from Colorado or the retractable syringe company, we're going to give you a $25,000 commission check. Who are you looking out for, Ken? And I just took my Series 7 not too long ago. So he says, who are you looking out for? The client? And he laughs and tells me to get the fuck out of his office. And right there, I was like, wow, this is absolutely insane. But there I was calling my guy back saying, you know what? Maybe you should buy maybe 3,000 shares of IGT. You might want to sprinkle in some of this retractable syringe company I was telling you about last week. And, I had to make a little bit of money. And that's probably the lowest point of my career when I made that phone call to get this guy into a stock that I knew at this point wasn't the best. but hey, and that was the only guy I did it to. But you know what? The guy made, good amount of money on IGT, and that really made up for the dog crap stocks that this firm was pushing. So
Right. And that retractable syringe, that's an example, or that's actually brought up in the Boiler Room movie, isn't it? I mean, it's been a couple of years since I watched it, but I don't know if you've seen it.
yeah, I've seen Boiler Room. I don't remember them doing the retractable syringe. We also did the Stratosphere, which I couldn't believe that we were doing an IPO of a Las Vegas hotel. And I was like, all right, this actually sounds legit. And even that one kind of tanked. It was incredible. But I don't remember in the Boiler Room what they were selling. I know they were selling what was it, Teradyne Systems in Wolf of Wall Street or something, some with applications of government and when he's going off, and those guys like, how'd you do that? But you know what's the best part of all those movies is the Ben Affleck speech, because I rolled into these firms wearing my bar mitzvah suit. I was still a little kid. I was still wearing a suit that was a decade old with a tie that I bought on my way there for $1 on the street. And this guy's looking at me. He's like, all right, the first thing you need to do is leave and go buy yourself a new suit, or you can't come back. And I had that speech that Ben Affleck did. It was almost verbatim. How much money we're going to make, all these suits we're going to have. You want to, go out and buy a car because you're going to be rich. I heard that whole thing. It was unbelievable, that movie. And the whole thing with, getting recommendations and then yelling to the broker and the other guy coming over and closing. That movie was dead on.
Did any of the guys who you were working with at the time, did any of them make serious money doing this?
Some of the guys, yeah. This one of my friends, I guess I could call him, the one of the guy who would be a little bit honest with me. This guy Ben, he was bringing in $25,000-$30,000 a month, easy. He had $100,000 a month one driving and this is a kid that I kind of knew from Brooklyn that was a knucklehead, and I'm being nice about it. This kid was not a smart kid, and I was in the high Excel program taking advanced math. This kid was like cutting out of school and just getting in trouble. Next thing you know, he's driving a Ferrari, making 25, 30, 40, 50, $100,000 a month, and like the original guy who laughed at me when I got the over a 90 on my Series 7, it was all about selling. It didn't matter what you knew. It was about tearing these guys or ripping these guys' heads off or tearing them up, breaking them down, and then asking for the sale and not saying a word. It was just, whoever spoke first after you asked for the sale loses. So you would just sit there in silence till the guy made a decision. And the best was, everybody knows about the rebuttal book. Oh, God, Aaron. There was a kid in this, I don't want to drop some names, but he sat there, he had a binder. So no matter what you said to me, he would flip to that page. So, oh, Kenny, I'm really, I like the idea, but I asked my wife. Next thing you know, he grabs the wife tab on the spiral notebook. He opens the wife rebuttal page. Aaron, let me ask you a question right now. Your wife's out in Macy's. She's buying a blouse. Is she calling you right now to find out if it's okay for her to buy that blouse and how much that blouse costs and what color you think that she should buy? I don't think so. Chances are you're the one making the money in the family. Am I right, Aaron? So this is just a decision that you can make right off the bat, can't you? And there was a rebuttal for everything. And this guy, again, not the smartest guy in the world, but he could sell anything. And it was something to watch. I used to just sit and watch in awe. And, he would have the guy on speaker, just like the movie, laughing his ass off while he was waiting for the guy to reply. And he already, he already knew what he was going to say back to the guy, no matter what. And he would just not get off the phone without getting some money out of everybody. It was incredible, actually. And I just couldn't do it. I couldn't be that high pressure, rip somebody's head off. I was the friendly comedian guy trying to, get people to laugh and schmooze and trust me. But then once I lost trust of these firms, you could hear it in my voice. And obviously these people could hear it in my voice. And I didn't have any faith in what I was selling. And, once I started learning about charts, and that was the end all be all, because I raised my hand at a meeting one day and I was like, well,
if it breaks 750, this thing doesn't really have any support till 5. Maybe we should start selling it here at 785 because it looks like it's about to break.
Kenny, we don't give a shit what you think you know. And if you ever mention a chart here, you're fired. And that was it. You know, it was, and that's being nice about it. It was almost to the point where shut up or we're going to beat you up. It was nuts. And that was when I left. And, you know, that was the end of my brokerage career.
That's full on, man. What a crazy story. So let's talk a little bit more about your actual trading. So tell us maybe what were your first few years like as a trader? Were they good, bad, average? How'd you go?
Luckily, you know, it came into a market that was just about to explode. You know, this was, 1998 when the internet was starting to catch on. You had Netscape, then you had a company called iOmega. And, you know, from what I knew about the market, stocks never went up 10%, 20% in a day, 50% in a day, unless it was some sort of cancer breakthrough or, you know, kind of a takeover. And then we started seeing these internet stocks, you know, DoubleClick and Real Networks and these internet providers just going up every day. So it was kind of a hard adjustment for me to appreciate the fact that, hey, this might be something new. You know, stocks can rip like this, and this is incredible. So I just started, you know, nibbling away at, you know, some of these high flyers. We didn't really call them high flyers at the time, but they became high flyers. And, you know, iOmega was just a disk drive company. Then there was, you know, a couple of companies that made pieces and parts for computers. There was something called the SCSI drive, a company called Adaptec, and they were flying high. And, you know, it was a crazy time. I luckily had a knack for it. So I started doing all right at the beginning. But once I learned about options, that's what got me in trouble, because I took whatever I made and started gambling with options. And I call it gambling because I was just buying them willy-nilly, not looking at the charts, going away from everything that I learned about when to buy a stock. And I was just buying takeover rumors. I was just, you know, buying anything. And I wasn't thinking about it because I thought, you know, if I can make money trading, then I could support my gambling habit on these options. But eventually the gambling habit on the options outweighed what I was doing trading. And I found myself in a pretty bad situation where I had to go then, you know, just wander the earth, I guess you could say. I would go to Wall Street and I didn't want to go into the office. I didn't want to do anything. I didn't want to talk to anybody, but I'd go to Wall Street and basically wander around until my friend said, "What are you doing?" And I was like, I try to grow a beard. I'm not the best. It was just the nastiest beard ever, but I'm walking around in jean shorts, Timberlands, and a Grateful Dead t-shirt, you know, for a couple of months until I got my head right. And then I just went back and I was like, all right, these are the concepts that my guy showed me that work. I'm going to just stick to this, and that's all I'm going to do. And then suddenly it became 1999, where you really didn't have to know how to trade. There was one thing to remember. If the stock breaks the previous day's high, buy it. And that was all you needed. There was nothing else. It was pure momentum. And it was fantastic because I was making 5-10 grand a day by 11:30. And then just, you know, again, being a pothead probably didn't help because here I'm making all this money. So it's 11:30. Now I could go to the park and, you know, play hacky sack and hang out with my friends or go play paddleball and smoke a joint. And I generally never went back to the office, and then I would see every stock that I sold out of at 11:30 up another 5 or 10 or sometimes 20 points, where the more disciplined guys, when I was making 1,000 or 5,000 a day, they were making 20 and 30 a day. So I might have wasted that opportunity, but at the time when you're in it and you've never made that kind of money before, I mean, it was adding up very, very quickly, and I was pretty happy about it.
I don't doubt it. I mean, $5,000-$10,000 a day. Who can complain about that?
Right.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, You don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Was there anyone at this point in time who was really sort of helping you with your trading? Someone who was, I don't know about a mentor, but someone who was like guiding you in the right direction? Like, I don't know, was it one of the guys at the firm who kind of taught you the ropes? Was there anyone who sort of played that role?
Yes, there was actually three guys. Well, I guess two guys were constantly trading, and they had no problem letting me sit behind them and ask questions while they were trading, which is kind of annoying. One guy, there was, well, let's call them Joe and Mike. Then you had Bill. Joe and Mike had no problem letting me sit behind them. But Mike, he was the guy that was making, 30, 40 grand a day trading, had a lot of positions on. He didn't want me sitting behind him. He didn't want me asking questions. But, Mike and whatever his name, Bob, I don't want to drop their names because in case they ever do listen, they don't want me to tell the story. But they were just awesome. And all they did was tell me everything in if-then statements. If this happens, then this should happen. This is where it could go, and this is where you put your stop, and this is what you think. This is where we think the stock could go because of this. And I just learned everything on if-then statements. And it wasn't till, a couple of months later till I finally started really starting to look at the charts. Because like I said, back then it was, if you saw a stock breaking the previous day's high, you had a 90% chance of success just buying that stock at that price and watching it take off. But there was a guy, and I'll say his name because I still use his concepts to this day, a guy named Isaac, and he just would drill these, little concepts in my head. It wasn't about charts. It was about sentiment. It wasn't, it was about seasonality and sentiment. And one of my favorite things that he said was, you don't have to rush into a trade. You could be late and right. And it's better to be late and right than early and wrong. Just wait for the trade. You'll be able to make the meet in the middle. I was like, okay, that's great. So it took the speculation out. I just waited for something to present itself on the day. I rarely took overnights because that was the typical day trader. You weren't taking overnights. That was the whole concept. You come in the next day, fresh, ready to go, and just try to make the meet in the middle. If the market gapped up, above some of those prices that you were ready to buy the stock, you would just pile in anyway. And it was just, it was incredible. But, never had to speculate too much. And, and then it was Isaac that really made my fortune by explaining to me the concept of, what's it called when all the dogs start moving? It's kind of the end of the bull market, the dash for trash, I guess they call it, right? He told me, and he was actually a penny stock trader. They had a consortium of traders, and he said to me, Kenny, I've never seen some of the stocks that are moving move. Not only did it not move, some of these stocks are up 300-400%, 1,000%, 10,000%. Some of these stocks were 5-cent stocks that would go into $5, $10, $15. This market is going to crash within the next month and a half. And that was in February of 2000. So I was like, you know what? You were my mentor. I agree, because I started reading up on some of these companies like CMRC. It was a company called Crossroads, just to name a few. Some of these companies had 8 employees trading at a market cap almost as much as GE. And they had no income. It was basically, I guess, revenue. And that was it. And these stocks were $30 stocks that were trading in the 800s, sometimes 1,000. So I started shorting them. and I was taking a beating for about a month. And then they all came home, and it was fantastic. I mean, I was a scalper by nature, but back then scalping was for a point or two. These stocks were falling in 10, 20, 30-point increments. I didn't even have a chance to cover. So once you're up that much money, I was like, you know what? Maybe this stock's just going to roll over and die. I rode one of those stocks from about, I guess around 400 down to about $4. And it was, I don't even know, a lot of those companies don't even exist anymore. Everybody remembers CMGI. You probably remember, SDLI. It was just nonsense that was going on back then. And, eventually, obviously, they all came home. And my problem was I made a lot of money on the crash. But then when, these 20 stocks that I destroyed got down 85, 90%, I bought them all. And guess what? About 80 to 90% of them went to zero. So I lost a big chunk of money thinking I knew a little bit more than I did, because I believed that a stock that goes from $800 down to, 12 or 15, it's got to be a buy here. And they all went to basically zero except for Akamai. That was the only one that I owned that ever staged a comeback, AKAM. And it was a pretty sick time.
Right. So just skipping forward a few years, how'd you go during the 2008 crash? I believe that was an interesting period in your career also. Yeah,
it was a lot of fun. It was really, I had a couple of friends working at Bear Stearns, and this was right when things started getting a little antsy. The word subprime was coming around, and there was rumblings that Bear Stearns might be in trouble. I remember Kramer came out and defended them, and here I am. I got a couple of guys telling me that they're not doing any business, they're not doing any more loans, their trading is like done. People are just sitting around staring at each other. And this guy's asking me if I know anywhere I can get him a job. I'm like, you work at Bear Stearns. I'm an idiot day trader. I was like, really? You're looking for a job? He's like, yeah, me and my 3 friends also. You know anybody? And I was like, seriously? And it had to be maybe, a couple of months later when the shit hit the fan. And sadly, I started shorting Bear Stearns when I heard these guys were looking for a job. And I think it was about a week after I shorted it that there was a rumor that Warren Buffett was going to come along and buy the whole company. Stock spiked about 15, 20 points. I figured I was going to lose the whole nut that I put into some puts. And I was so happy to see Bear Stearns rolling over. And I turned this big loss into a gain again that I got out. And obviously, this stock eventually went to zero, which I could probably be living off that money for the rest of my life if I would have stayed with that position I had on. But I didn't do as well on that crash than I did in 2000 because I wasn't as convinced that the end of the world was coming as I was in 2000. And 2000, it was easier for me because I saw how the stocks went up, and I figured, all right, these are going to give back at least 50, 60% of this parabolic move that they had. 2008, I didn't want to believe that capitalism was on the ropes and that the entire banking system was about to collapse. It didn't want to set into my brain. So at one point, I was happy just nibbling on some Lehman Brothers short and Bear Stearns short and, some other stocks, but, nothing like 2000. But the best part about it is when the real shit hit the fan, I was in complete cash. Sadly, it could have been the most monstrous trade I've ever had in my life, staying short the stuff that I had. But I was very content being out of the market, being in cash, and just waiting for, some stability to come along. Because I figured, some of these stocks are going to be fantastic buys, even if I have to wait 5 or 6 years. And obviously, 8 years later, look where we are.
Yeah, so tell us about how you traded post GFC. I mean, we were talking a little bit before this, and you said that you kind of struggled a little bit as the crash was recovering.
Well, because I came from the school of shorting, and most of the money I've ever made was shorting. So after 2009, and I was convinced. I was like, all right, the government's bailing everybody out. We're probably going to have a monster rally. But then after 2009, 2010, 2011, as we kept going higher and higher and higher, I thought that I saw a little topping formation on the S&Ps and the QQQ in particular. And, I decided to go about 50 times huger than I had ever been, in the last 5 or 6 years. And it was going well for about 20 minutes. Skipping around the office, I called the highs of the market. We're going to roll over, give back a big chunk of this. I'm going to be rich and I'm going to retire. And somebody said, Ken, you might want to get back to your desk. JP Morgan, I think it was JP Morgan or Morgan Stanley. Yeah, they just upgraded every stock. And they came out with some lists. They put all these new predictions on the S&Ps and on the Qs. They upgraded like 30 sectors. And I just sat there like a deer in the headlights, just I couldn't believe that I left this money on the table. And then when it started to become a loss, my mouth was dry, my hands were sweating. I didn't know what to do. And I just sat and watched it for an hour, hoping that, maybe we'll roll over. I could take some of this off. And then at one point I was just, it just went parabolic right, after 3 o'clock, and it just kept going. And I took half of it off, and I was like, please God, maybe they'll give some of this back tomorrow. And they capped the market up tomorrow, and we started ripping again. And it was a nightmare. And if you watch any of my videos on YouTube, that's when I really became this psycho bull, because I said, you know what? What was I thinking? The government has saved us from the Great Depression #2. They seem to have taken over the stock market. And why would I want to fight the government, fight the Fed? I'm just going to go long. And that's when I got, I bought some Qs. I think it was March of 2012. And the family's still in the Qs. And, it was a great buy. Obviously, I wish I would have bought a little bit more of everything. But, yeah, it was a pretty good move. But, man, did I take a beat down in, I believe it was March of 2011 or March of 2012. I try to block it out of my memory, as much as I can, because it was a horrifying day. It was, no doubt.
Yeah. Okay, so let's talk more about how you're actually trading today. Let's get into that. So, I mean, how would you describe what you do, like kind of your trading methodology that you're implementing these days?
Well, I've gone back to what was doing well in 1999 and 2000. Obviously, it's not as easy. We were trading in eighths of a point and quarters of a point, so the same momentum that you were making 12-cent and 25-cent increments, and I was trading a lot larger size. But I've gone back to what was making me money. That simple concept of a stock breaking the previous day's high, it's similar to that. What I try to do now is it's hard because there's not many stocks that are getting beat down, but I've been pretty good at finding stocks that are coming out of a malaise or coming out of a depression or just coming out of just sitting around and consolidating. And once I see them reversing and breaking some previous, not just a day, but going back, a month, sometimes 2 months, sometimes a year or so, that some of these stocks have been sitting around and doing nothing, that once they break out of that channel or that range that they're sitting in, the move, especially because we're in the greatest bull market of all time right now, in my opinion, once the shorts get nervous, the stock goes and has a monster move. And I just go from stock to stock and I try to find these. And even if I only find one of these a week, it's enough to make a living off. And if you want to trade for a living, you can find these ideas on a more subtle basis. It all starts with reversals. And I know you have a friend of mine on the show not too long ago, Zach. I was calling him the VWAP Emperor, because about 3 or 4 years ago, he told me, he's like, that candlestick breakout pattern that you're looking at, once it breaks over the VWAP, the stock really starts to get going. And I said, what's VWAP? Because, again, I'm pretty familiar with a lot of different concepts, moving averages and, stochastics and Bollinger Bands and all this crap that I was trying to learn. And he's like, just why don't you plot the VWAP up to, on your charts just to give you a guide? And I was very hesitant because I was set in my ways. Things were going well. And once I plotted the VWAP on my chart, using, the 1 minute and sometimes even a yearly VWAP, it's remarkable that this thing's been coming into play so often. But once these stocks reverse and they break the VWAP, the trades have been working about 90% of the time. Now, I'm not saying I find these every day, but if I find 3 a week, that's really all I need. And lately, it's been phenomenal. I've been finding, almost 1 a day. Found another one a couple of days ago. I don't know if you want to get into symbols, but most of the charts, and, I could give you a couple of symbols. It all started with, Taser. If you look at like a 10-year chart in the Taser, and you plot that next to an AMD chart, or if you look at this stock called ENDP, or you look at GoPro, or you look at what was the one that we just got into? First Solar, FSLR, and today we got into CLDX. They're basically all the same type of stock. And if you look at this chart on CONN, CON, these are the stocks that I've been making money on lately. And I don't have to be a very active trader because all I'm doing is I'm finding these positions, I'm plotting out where I think they can go, and then I'm looking at 9-month and yearly VWAPs, and my God, they're all going to these 9-month, yearly VWAPs when they start to break out. So I'm using the VWAP as a guide to where I might be looking to take some profit. And if it does break over these yearly VWAPs, you're getting another 10, 15, 20% on some of these stocks. This Con stock, this is a electronics resale place that's, I've only seen them in Vegas when I was out there. Stock was an $85 stock, sitting at $6 about 3 weeks ago. They had an earnings report. Stock was gapped down into the reversal, broke over the VWAP that day. And the reason I day trade is to find swing trades, because I've been doing much better on my swing trade ideas than the day trades. Because when you're day trading, you're sitting there and you're watching every penny go back and forth. Oh God, should I get in? Should I get out? Should I get in? Should I get out? Once these stocks break this, what I call the exhaustion situation formation, they're gone. First Solar, who I never thought in a million years I'd ever look at that stock again. I hate that stock. First Solar, one of the worst stocks ever. But the other day, met the criteria, broke over the VWAP, stock reversed. Next thing you know, you're getting a 4-point move. And if you're looking at, I know some of you guys are thinking 4 points is not a lot, but if you went out, and bought the calls for 40 cents and you're selling them for $2 3 days later, it's pretty good. And that's what I've been doing lately. And I'm trying to teach people this exhaustion pattern that I found, because what's great about it is that not only do you have the shorts who are freaking out because the stock suddenly started going back up, but then you have the encouraged longs who have been dollar cost averaging in these beat down awful stocks that start to buy more, and they get encouraged. And next thing you know, every once in a while, you get an AMD coming from 250 and 325 where the breakout was, that ripped to $8, and suddenly this could be a legitimate turnaround story. And then you got this Con, whether or not it's a turnaround story, I'm out of the stock. This thing went from 750, and again, I'm not telling you I catch the bottoms. It's the turn. Once it breaks over the bottom consolidation range, that you look for it to get to the next range. And this is a stock that just went from, $7.25 up to $11. And, this part you don't read about in books, but I love the stock short the other day, because after the stock went from $6 to 11, some genius analyst, who I have no respect for analysts on Wall Street whatsoever, because I know how shady the business is. This genius thinks to put an upgrade on the stock after it moves 100%. So I was like, you know what, guys? That's your top. So look for this stock to give back a good percentage, or maybe all of this pop that this analyst, in his awesomeness, has decided to upgrade this stock. And in my theory, and this is, again, some people are going to get bent out of shape when I say this, but I know it happens. Analysts are paid shills. Let's assume you got a big amount of Con short and you're getting beat up now because you didn't cover. You call your analyst friend, hey, do me a favor, upgrade this stock tomorrow so I could short into your upgrade so I can make some of this money back, after it retraces. And that's what happens. I don't care what anybody thinks they know. Nobody knows anything. These analysts, and, again, just like GoPro, here's a stock that analysts were upgrading at $90, saying it was going to $150. It's the camera on a stick social media company now. It's not just a camera. So at 90 and 80 and 70 and 60 and 50 and 40 and 30 and 20, they don't think to downgrade it. But this genius downgrades it when it hits 1050. Boom. Yeah, sure, it went down 2 more points after he said it, but there you go. When some genius analyst downgrades or upgrades a stock after a monster move, it's almost like the Barron's theory. When Barron says, is it safe to get back into the market? That's the top of the market. Should you be getting out of the market? That's the bottom of the market. It's incredible how it works, but I've been watching this for 20 years. It does work like that. It's incredible.
Yeah. Okay. And these trades you're describing here, are you trading the actual stocks or are you trading options?
Well, see, I will trade the stock at first. And, for instance, on First Solar, it all starts with a day trade. You catch the reversal, breaks over, my reversal price, we're in the stock. Now, the reason a lot of these traders and day traders and, basically anybody in general lose money is that they take a day trade that's not going their way and suddenly it's a swing trade because they didn't want to take the loss. Next thing you know, they got an $80 loss they don't want to take. Next thing you know, it's a $250 loss. Well, if you didn't take an $80 loss, I'm certainly not going to sell it here. 3 months later, you're getting 10 Ks sent to your house. You're sitting on a conference call with a company that you don't even know what the hell they do is reporting earnings. Oh, man, I hope they say something good. This better be good, huh? You're sitting on a conference call. You're calling investor relations and making friends with the lady who works at headquarters. And that's the wrong way of doing it. Day trading for me is to find not only the day trade that works for the day, but to find these decent ideas to turn your day trade into a swing trade in a positive way. So First Solar started out, I think, I think it was 34.65. So it starts out at 34.65. I'm trying to pull up something. Around 34.65, we were in the stock. And we had a target of, 36.60. But am I going to hold 1,000 shares or 2,000 shares of First Solar? Absolutely not. I buy 1,000 shares, stock spurts 40 cents. Guess what I'm doing? I'm selling 800 shares of it, taking the money off the table, and I'm holding 200 shares as a swing trade to see if this thing actually gets to 36 and change. And then we're in a swing trade. Fantastic. Now, if it could break 36.60, we got a target of 37.50. But at that time, I want to be in 1,000 shares. So now that the swing trade's going my way, I'm thinking, hey, why don't we buy some 37.50 calls 10 days out here for 50 cents? Because if this thing really does pop and goes to 39 and change, we'll be able to make, about $1.50 on these 50-cent options. So that's the evolution of what I try to do. I turn the day trade, the winning day trade, into the swing trade, and then I'll start going looking for options because chances are I still want to be in the stock, but I don't want to commit too much cash, and obviously that's what options are for. You could have the same couple of thousand shares of First Solar without having to lay out $70,000. And then obviously if things don't go well, who the hell knows, overnight, 2,000 shares of First Solar, they come out with some bullshit news or their solar panels are causing cancer. The stock opens up at $8. You got $1,500 worth of options. You're not worried. Yeah, you're down 1,500, but you got 2,000 shares of the stock and the stock's trading at $20. Next thing you know, that could be the end of your career, depending on who you are.
Yeah, okay. So I'd be keen to hear a bit more about how you decide on a profit target. So, like, how far ahead of time do you have an opinion on where a stock might actually go?
Really comes down to, once I find this exhaustion situation formation, I start looking at the low prints from where the stock had broken down. So I don't know if you're looking at charts. I'm sure some guys, if you want to follow along in this First Solar, When we bought the stock, all we were first looking for was to break this 34.65 area, which was, the high prints of the two previous candles where it came from. So then I look at the high print from where it broke down from, the low prints from where it broke down from, which is around 36.75. So that was my immediate target for the short-term goal. And then I'm thinking, hey, if this thing could break that 36.75, then I start looking at the high prints from a previous move up, which got me to about 39.32. So I'm thinking, hey, if this thing could break through here, we're looking for the next range. And now look where the stock is. You're at $39. I like whole numbers. I took some off the table today, and I'm down to the last lot. And now if this thing breaks today's high around 39.12, I'm looking for it to get to that next top range, which is about 39.72, and then I've got $40.40. So I plot the chart, and I give myself exact targets. Again, no one's going to hit them to the penny, but I have exactly what I want and where I'm thinking about selling about, as soon as I'm in the trade. I'll start drawing my lines and say, if this happens, then this should happen, going back to the concepts I learned in 97. If this breaks, then it should go here. If this breaks, it should go here. And this is where our stops are to protect our profit. And, that's, pretty much how I do it. And once you find something that works, really all you're supposed to be doing is that same thing over and over again. I mean, that's how I found, these biotech stocks. If you want to take a look at another one, now I'm not going to say I picked the bottom on this one, but Clovis, and it was kind of luck also. But we're talking about a stock that was $116. I don't know if you know about Clovis, CLVS. Here you got a stock that the drug doesn't work, FDA this, FDA that, they're running out of money. Stock's down to $11.50. Did I buy it at $11.50? Absolutely not. But if you see, the bottom range was between $11.50 and around $17.50. So I didn't buy at $11.50, $12.50. I waited to see. I was like, why would this stock break $17.50 if it was virtually going out of business? So at $17.50, and again, here I don't buy the stock because, again, it's a biotech stock that I thought, and as I read on the interweb, they're going out of business. They got nothing going on. So I bought some $17.50 calls that day. And then when it broke out, I was like, wow, if this thing could break $21, we're looking for this thing to possibly even go back to $30. So, we sold out of the quick hit on the options, and we what we thought were lotto tickets at the time, buying some $25 calls, were phenomenal. And of course, I cannot believe the stock went back into the 40s because we were out of the stock around 29 and change. But hey, you're not going to complain when you make 3 or 4%, 3 or 400% on your options. And again, why did I buy Clovis? Exhaustion situation formation. The sellers just seem to have dried up. AMD, ENDP, and what we just bought today, I'll give you a freebie. Another piece of garbage biotech stock. CLDX. Doesn't look like much on the chart, but it stopped going down, which is the first sign of something good. And you had this little bottom range. It couldn't get back above about 380. So what do? You break 380, you got to buy the stock. And our short-term goal was just 410. We got the 410 today. So now that it broke 410, I looked to the candles from where the stock broke down from originally, which is around 440. And that's our next goal. Breaks 440, then I'm looking for this thing to go to around 470. Now is where it gets fun because you have a gap to be filled. So if this thing could get back over around $5, without any news whatsoever, this thing could be a $6.20 stock very, very quickly. And if you're buying something at 385 and dumping it at 620, you're doing something right. And that's the last one I just bought. This one I bought the stock because obviously it's pretty cheap. And again, I only start out with a couple of thousand just to get a feel for it. If it pulls back and goes right back down to 385, no harm, no foul. But had a nice close today and looks pretty good, And that's, really, again, it's the same thing over and over again. That's why I tell all my students, this is not exciting. it actually should be boring. The more excited you are, you're probably doing something wrong. You shouldn't be running around trying to find every symbol. I got guys coming into my chat room. Hey, did you trade this? Hey, did you trade that? I don't even see these stocks. These $3 stocks that are up 500% for the day. I'm like, nah, it's probably just going to give back 80% tomorrow. It's not my thing. When these little garbage stocks go parabolic, out of nowhere, it's usually going to come right back in, which brings me to another one, was this EXCL. And if you guys are following along, and, again, I appreciate you having me on and shooting the shit like this. Hopefully you guys are following along. Here's a stock, EXCL. Now, Aaron, this would get me in such trouble back in the day. And this is where discipline comes in. I look at a stock that was $4 in February. It's trading at $15.50 now and pretty much has gone parabolic. So my shorter, my bear inside me saying, oh, this thing's going to come cratering back down to 11 at least. I got to keep shorting it. But there's no reason to short these stocks right now until I see, what I like to call the blow off top. Obviously I'm not the only one that calls it the blow off top. But now what I look for on a stock that's gone parabolic like this, the only time I'm going to short the stock is when it gaps up, rolls over, and goes red. You understand what I'm saying? That's the only time. And again, you guys out there that are trying to pick tops, let the top pick itself. Another Isaac-ism. Let the top form and then short the stock. You're never going to pick the top, and you're going to go broke trying. So one of these days, I'm sure EXCL is going to give back a little bit. But you know what? Wasn't today, wasn't yesterday. I thought 15 might have been the spot. Broke 15 yesterday. Looks like it keeps on going. For all we know is that this thing has a drug that's about to be unleashed onto the world that's going to save the planet. This thing could be $1,000 stock. I don't know. I just know if it gaps up tomorrow and let's say it's at 1580, rolls over, breaks to 1 minute VWAP, trend starts to reverse and this thing goes negative, then you short it. Sure, I'm going to sacrifice 50 cents in there, but if it's time to short the stock, it's not just going to pull back 4 cents and sit there. It'll give back another 50 cents, possibly $1, and the profit taking will ensue, and then you can make some money. Once again, you'd rather be late and right than early and wrong. It really comes down to the same concept every time.
So just going back to something you said earlier in your answer there, you talked about these range formations that come in when the sellers dry up.
Right.
How are you actually defining a range? Like, how would you identify that on a chart?
All right, let's take a look at the con chart, if you can, guys, if you're following along at home.
Just so you know, Kenny, a lot of people probably don't have a chart in front of them. A lot of people listen while they're like driving on the way to the gym, that sort of thing. So maybe if you could just sort of broadly speak about that example would probably be most helpful.
All right. Well, you could basically see on, I'll just say it in general terms then. If you see a stock that hits 650, that's been down from $80, and every time it goes to 650, it holds 650. And then a week goes by. It pops to 685, rolls back to 650. Hey, it held 650 again. Then it goes back to 682, rolls back over, goes to 650. Hey, guess what? It held 650 again. This stock did that about, a dozen times. And every time it got to around, this one was about $7.15. Every time it got to $7.15, it rolled back to $6.50. So finally, and the beautiful part about it, it was an earnings reversal, something that I talk about quite often to my guys. When are people going to make decisions? It's when the earnings come out. So apparently, whether this is true or not, apparently the numbers were good enough where the people that were debating whether or not to cover their shorts finally made their mind up. And once that stock broke 715, then you're looking for, like I was saying before, where did the stock break down from when it last fell into a new range? So on this one, it was about $8. So I was like, hey, I'll buy something at 715 with an $8 target. Next thing you know, it got to $8 that day. And then we were like, wait, if it could get past 8, and then we look for the next breakdown price. And I had 885. And I was like, can this stock really go from 715 to 885? You're sure? It sure can. And then from 885, I was like, wow, this thing's still got some momentum. possibly gets to 950, because 950 was where another level where it kind of broke down from in the past. So I'm looking at a chart going back to, May, and it sat around from June till September 7th. So you got, 3 or 4 months of it just doing nothing. So then you got the shorts covering, you got the bulls encouraged, and obviously the stock went all the way up to 1250, and then the genius analyst came along and, upgraded it. But the more a stock continues to hit a certain area, and usually it's a 52-week low or even a 2-year low. In this case, I think it was a 3 or 4-year low or an all-time low, as a matter of fact, on Con. If it keeps hitting that same price and can't break down, now, again, you don't want to buy it then. You just want to wait till it breaks out of that range that it's formed. And once it does, the shorts get nervous and you get the short squeeze. And then obviously the algos come in and everybody starts going nuts with, levels and black boxes and gray boxes, and all your high frequency trading gets involved. And next thing you know, you have a stock that goes from $6 to 12. And, if you look at AMD, same kind of story. And, it's all about these bottom ranges. And once they form the range, all you're looking for that stock to do is break out of that bottom range and just get to the next level up, which could be just, 3%, 5%. And every once in a while, you get a monster. So going back to the whole concept, I'm not picking the bottoms. The bottom is forming for me. I'm just waiting for it to break out into the next level and, making the meat in the middle.
Got it. Okay. Good stuff, man. Well, I really want to get to, we're pushing on, what is it? Almost 70 minutes now. I really want to get to some tips and pointers, some suggestions you might have for traders who are still developing, still trying to find their feet and find their way in this game. So, one of the things I'd like to ask you is, what's one thing if unprofitable traders just understood, they'd be better off?
Wow. Well, I tell this to everybody. If you ever find yourself saying, let's see what happens, get the hell out of the trade, because you're hoping. And that's what gets people in trouble. Let's see what happens. It's the same thing, the day trade becoming a swing trade, becoming an investment. Don't let it happen. How many times have you heard? You probably heard it. Everybody's heard it. I'm stuck in this stock. Are you? Really? You don't have internet access or telephone? What do you mean you're stuck in the stock? Just press the button. Rip the Band-Aid off. Do it. It's just one trade. Don't let it ruin your life. It's just one trade. People don't seem to understand that. You're going to lose money. Even if I had 90% winners, that 10% losers can outweigh the 90% without proper risk management and money management. Don't let the losers outweigh your winners. And usually you're saying to yourself, let's see what happens. And it really sounds too easy to be true, but everybody says, let's see what happens. And if you find yourself saying, let's see what happens in a losing position, chances are it's going to get worse. Chances are it's going to get worse. But the other concept along those same lines, if you're in a losing trade, say to yourself, would you be, assuming you own it, would you buy more here? If you don't immediately say yes, dump it. Because if you're not confident enough to buy more while it's falling, then you shouldn't be in the stock. Get out. It's just one trade. If you're going to be successful, you're going to have so many losers. You just have to manage them. And that was my problem, because I used to let's see what happens all the time because I had a lot of money and I was like, let's see what happens. What's the worst that'll happen? Enron. Oh, what's the worst that'll happen? Oh, WorldCom. I've been in all of that. I was like, what? Oh, Enron. Oh, yeah, it's down to $8. Where it's not going to go to zero, is it? And next thing you know, what do I know? I didn't know anything about Enron. I just saw a chart of a stock that went from 80 to 8. And I just said, let's see what happens. When it was down at 5, let's see what happens. Next thing you know, it's at 0. And, it was just an awful, awful thing. I'm telling you, it's that easy. When you mutter to yourself, let's see what happens, just hit the key. or click your mouse and get the hell out. I'm telling you. And you'll feel better. You get rid of the stock, you ban it. You know how many stocks I banned from my life? So I just like, you know what? Every time I go near that stock, I lose money. You know what? Guess what? I'm not going to trade it anymore. And I'll tell you one more thing. The funniest thing is I hear about this all day, even today. Kenny, I seem to do really well in the morning, and then I wind up churning my account and then giving back most of my day in the afternoon. What do you think I should do? Why don't you stand yourself in the mirror and say that again? What do you think the answer is? Well, Kenny, I make money during the morning every day, and I lose in the afternoon. What do you think I should do? Here's a concept. Don't trade the afternoon. Let that one sink in. It could be that easy. And it's amazing. The guy was like, really? That's all you have to offer me? I'm like, yeah, what do you need? You just told me you make money in the morning and lose in the afternoon every day. You don't have to hang out just because you feel like you want to be a trader. It's about money. Make the money. You do this for a living, or you're attempting to do it for a living. Why would you stay at the poker table when you've won the money? I won the money. Leave. No one's giving you drinks or back rubs when you're sitting in your house in your underwear. Or maybe they are, but why are you sitting at the casino table when you won the money? Leave. It's all right. You can leave.
Loud and clear. Solid advice, man. What are some illusions people have about traders which aren't entirely true?
We wear suits. Still, some people think that traders wear suits. I don't know when they stopped wearing suits, or when you hear the word trader, everybody thinks we're yelling and screaming on the floor. I'd say within probably 5 more years, you won't have any of that going on. But I think the illusion that you need to be constantly trading is what gets people in trouble. That illusion of, I'm a trader. I need to trade. No, you don't. Not trading is trading. Knowing when not to trade. If you're sitting there still at the computer after having 3 or 4 decent trades, if you're sitting at your computer between 12:30 and 1:30, you're just a maniac. You're a glutton. You got some issues. Take at least your hour off. Between 9:30 and 11:30, don't talk to anybody. That's your moment. From 11:30 to sometimes even 2:30, 3 o'clock, you shouldn't be doing anything. You should watch the Rangers being formed, but you shouldn't be executing any trades during that time. You're just asking for trouble. And the concept is that, well, I'm at the desk, I might as well put some trades on. That's why you get guys that lose money in the afternoons. They're blinded by this idea that they're a trader and they must trade. Flat, my friends, is a position.
I've got to say, Kenny, thank you so much for coming on, man. We should probably call this a wrap. Where's the best place listeners can go to find out more about you?
Well, the easy way is to email me. It's kennyglick@AOL.com. And please don't mock me for having the AOL account. It's something near and dear to my heart. I will keep AOL forever because I remember the days where all we had was dial-up. My website's hitthebid.com. It's kind of just a portal to get into my private chat that I have. If you do want to find any more information about me, just email me and we'll talk. KennyGlick@AOL.com. And generally I let people hang out with me now. My new way of doing business is just hang out with me. I'm an easygoing guy. I drill these 4 or 5 concepts into your head. A lot of my Isaacisms, I will put those into your skull, and we hang out. We have a lot of fun. And because people want to be at the desk, once we start making money, if you like to cook, I could teach you how to make a nice meatball. I have a lot of Italians in my family. I'm a Jewish fella, by the way, and I make a ridiculous sauce. I make psychopathic raviolis and stuffed shells. Make an incredible just amount of food because I was taught by my wife. My wife's aunts have all married into a large Italian family. So we sit, we make some money. I treat my room like a family and everybody in there. So what I do now is I'm like, come hang out for a month on me. Let me show you what I do. If you can't grasp some of the concepts within a month, and I don't show you how to make money. We part as friends. And then if you want to stick around, I just do a one-time lifetime membership to basically be Kenny Glick's friend. And we could talk about that after you spend a month with me if you like what I do. And what gets people in trouble, some people show up at 1:30 on a Thursday afternoon. Where are your picks? Where's all your genius ideas, Kenny? I saw your video on YouTube. It says you never lose. Where's your picks? You can't come into my chat room on a Thursday at 2 o'clock expecting some monster idea that's just going to blow your mind. It's a lifelong dedication that I ask people to do. Because if you're going to be a trader, you have to take it serious and learn the concept. And I'm not saying mine are all you have to learn, but I show you some basic concepts that will help you succeed. And the hardest part is sticking to those few concepts that you have proved, or I have proved, that work pretty well. So that's me in a nutshell, my man. Thank you so much, man. I've heard so much about you, and so many people were so excited that I was on your show. And you're doing an awesome job, man. I mean, from Australia, I mean, yeah, fantastic stuff. I'm really excited that you had me on. Thanks a lot.
Right back at you, man. I appreciate it. So you gave us your email, you gave us your website. Are you also on Twitter as well?
Yeah, I'm at Hit the Bid Radio.
At Hit the Bid Radio. Good stuff, man. All right, well, let's call this a wrap. Kenny, once again, thank you very much for doing this. I appreciate it.
No, I appreciate it too, brother. This was awesome. Thanks a lot.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that
survived storms at sea, torturous sleeping patterns, and run-ins with pirates? We spend a fair amount of time discussing how Adrian actually uses stats, volume profiling, income from financial markets. Adrian, or at Addy. What is going on, team? I hope all is well with you. Thanks so much for being here. For this episode, the trader who I had the great opportunity to speak with and who you're about to hear from is Adrian, or at APR17 on Twitter. Going back in time, Adrian was a professional sailor for almost 2 decades, but for the past 6 years, he's been on dry land, taking an income from financial markets as an independent day trader. Adrian primarily trades the Bund and the DAX, though he initially started out in foreign exchange. His trading strategy is influenced by support and resistance areas, volume profiling, order flow, and stats. After talking about how Adrian survived storms at sea, torturous sleeping patterns, and run-ins with pirates, we spend a fair amount of time discussing how Adrian actually uses stats and some things to watch out for and why it pays to be process-driven. Please enjoy this episode, guys. I'm Aaron Fifield, your host, and here is my guest, Adrian.
Hi, Aaron. How are you?
Adrian, I'm good, man. What's up?
Not much. Been just trading today.
Yeah, cool.
So you had a bit of a storm last night?
Yeah, man, it got pretty wild. Did you see the photo I posted on Twitter?
Yeah, I did. Yeah, was that a tree branch that come from the window?
Yeah, from across the road. The whole sort of top of a tree blew off and flew across the road. Branch came straight through the window, and the road was like blocked, obviously because the tree was across it. The roof next door on our neighbour's house has like a 3 by 2 metre hole blown in the side of it. What else? The guttering along the front of our house blew off. The fence in the backyard is on a total lean. It's only been held up because there's a couple trees behind it. Yeah, it's a bit of a mess. We had
busy days trying to sort that out.
Yeah, we're gonna have to obviously get on the phone to insurance and a lot of cleanup. Oh, there's so much shit in the pool. including part of the neighbour's roof next door. We've got to try and dig that out, so that's going to be fun. And it's a bit too cold to jump in there and grab it at this stage. Summer's not quite here yet.
Yeah.
But no, it's all good. It's all good. How's your weekend?
Yeah, good. Just spent some time with the missus. Done my usual weekly review and trade and analyse and all the work around that side. So quite busy.
Very good.
But my missus works away from home during the week, so I'm home alone. So I try and spend a bit of time with her at the weekends. Otherwise, we both just end up working all the time.
Yeah, absolutely. And you've got to have that balance. So before we talk trading, I'm actually really interested to hear a bit about life before all of this. You were a pro sailor, is that right?
Yeah, I was a professional sailor for 17, 18 years. Sailing, I sailed around the world, lived in America, Caribbean and France. So I had quite interesting life doing that. And sailing's always been a bit of a passion for me. But it got to the stage where I was reaching, my early 40s, and there's a lot of travelling and living out of hotels involved with pro sailing. And it was kind of, what do old sailors do? And I was getting a bit bored with the travelling and, out of hotels. And I wasn't doing that much sailing anymore. I was managing projects and refits and stuff like that. So I started, I decided I was going to leave it, leave sailing before I got too old and try and make another career. So I left that. I did some project work for a friend of mine who ran a currency exchange and doing deliverable currency. And I was managing the new build of his website and his database and stuff. And that's what got me interested in trading, because they were obviously using charts and stuff for the Forex market. And that's how I got into trading. Started doing trading part-time on the side while I was doing other projects. And then decided a couple of years into it that I wouldn't mind having a go at making that a career. It interested me a lot. Had a lot of similarities on the outside to I used to do a lot of weather routing and analysing the weather in my pro sailing career. And on the surface, it seemed to be very similar to doing stuff like that. And that side's always interested me, and process and stats and stuff, even though at the time I wasn't particularly good at stats. And whilst I thought I understood them, my understanding wasn't as good as I thought it was.
Yeah, okay. I mean, the stats in particular is something I'm very keen to ask you about. So we're going to really get into that in a moment. During your sailing career, what were some of the competitions that you participated in?
I did the Fast Start race 7 times, did the Newport Bermuda, done Cork Week twice, Cows Week 9 times. I did the Clipper Around the World race. We used to have series called the Rourke races, which are offshore races basically around the English Channel. I did so many of them, I can't even remember the number of them. So I used to compete a lot around the Cairns and offshore.
Full on, okay. And do you have any stories from like being out at sea and any like wild weather and huge waves, anything like that you sort of came up against?
Yeah, I mean, I've been out in storms, in Bay of Biscay where other boats have sank. I've been one of the first trips. It was my 3rd transatlantic, and back then in the late 80s, early 90s, that most small yachts didn't have GPS. You couldn't afford GPS on small yachts. So we were still doing transatlantics at the time, using sextants, astronavigating by the sun and the moon and the stars. And I was doing a delivery, taking a tow from France to the Caribbean, and we was hit by a storm about 600-700 miles off France, and it was so windy that at one stage the sea went from being humongous waves about the size of the boat, 40 to 50 foot size waves, to in the peak of it that actually the sea leveled out and was complete foam. But the boat was leaning over about 50 degrees. just permanent hill with no sails up. We had taken the sails down because it was just too windy for the sails. And at times like that, there's a saying which is, I think, stolen from World War One, but there's no atheists in a small boat at sea in a storm.
Yeah, I can imagine. I mean, what do you do in times like that? Do you just sort of sit still and hope for the best? Or, I mean, is there anything you can do?
There is stuff you can do, but you do very much understand after you've spent a certain amount at sea that you are very much in behold of Mother Nature at times. So there's stuff you can do, but if the sea wants to take you, the sea's going to take you. I mean, one of the worst things I ever saw was coming across mid-Atlantic, a bunch of life jackets, an old-fashioned cork-filled life jackets all tied together into a raft. And they've been out there for a while and they're all stained and everything. And so obviously somebody tried to use it as a raft. And back then we had no ways of communicating with shore. So that was before sat phones, or sat phones were small enough to take on small boats of like 30 to 40 foot size. So we couldn't report it. Reported it once we got to the Caribbean side, and it had a ship's number on it, and it had been a fishing boat that sank about 6 weeks, and they never recovered anyone. They just disappeared. So we had come across the last place where obviously the survivors had tried to make, how many of them we don't know, tried to make a raft and had a guide there. It's quite unnerving when you're like 2,000 miles from the nearest piece of land. But it does make you realise what the human body or the human being is capable of in them conditions when you get to situations where you're so tired or hungry or dehydrated that actually you can keep going and do stuff, and you see people that you never thought would, in a moment of crisis, stand up, and people you thought would be strong in moments of crisis crumble.
Yeah. No, that's really interesting to hear about. I mean, I don't know if this might be a bit of a silly question, but you know, during your sailing career, was there ever a risk of pirates out there, you know, in the seas?
In certain areas, yeah, south through the South China Sea, and there's pirates, and they're not what people imagine to be. They're basically, they were basically fishermen that could see a expensive boat sailing along in a race and were opportunists. So they will try and come alongside, or they'll go right in front of us and drop their nets like 20, 30 meters just in front of us, hoping we'd run into them. So they were opportunist pirates. So they weren't going around especially looking to pirate. Their main thing was fishing. But if they saw opportunity to take advantage of unarmed or undefended Westerners, then they would take the opportunity.
Okay, so did you have run-ins personally like this?
Yeah, we was trying to be boarded, and they tried to get alongside us a few times.
Yeah, was there ever a time when they did come on board?
No.
Okay.
I always, on that trip down there, I spent 9 days at sea. I slept every 2 hours for 20 to 30 minutes, and that's what was my routine because of the risk of pirates and that sort of stuff. So I was constantly going up on deck. So I spent 9 days doing that. I never slept more than 40 minutes in that 9 days.
That's crazy. What happens to your mind during when you're sleeping with that sort of pattern?
It's not particularly good for focus or making good decisions. You operate at a very base level. You're constantly tired. At one stage, I got so tired I was hallucinating. So that when I had a 40-minute sleep. But you learn a lot about how to get away with shorter sleeps. So whilst that wasn't particularly good, I learned lessons about how to manage my sleep in the future. So I've done a 20-day trip where every 4 hours I slept for only 1 hour. So I never got into REM sleep. So I never woke up. I woke up feeling tired, but I never woke up out of it. That was a much better routine, and I could maintain that for like 20 days. But sleeping 20 to 30 minutes every 2 hours was crap. You make a lot of bad decisions.
Wow. Yeah, I imagine that'd be really tough going. I mean, why were you doing this? Were these solo trips? Like, was there no one else on board with you for this?
No, it was a fully crewed race, but it was an amateur race. So I was the only professional on board, and I was So I had amateur crew with me, and so you're responsible for them. And during the South China trip, it was pretty windy, so that made the conditions quite dangerous. And with the amount of fishing boats around, some of them were opportunist pirates, and some of them were just fishing boats. But yeah, with all the nets and fishing boats, which don't always have proper lights on, so you can't see them, you just had to be on the ball all the time.
Yeah. Okay, full on. All right, so let's talk a little bit about trading. Talk to us about how you went from being a sailor to actually becoming a trader. You mentioned that you were doing some sort of project work with someone who ran a currency exchange. Would you mind elaborating on that a little bit?
Yeah, he was a currency dealer. So in UK, there's various currency dealers that if you want to exchange money via the bank, they charge you quite a large percentage, or they used to charge quite a large percentage. So various companies set up as intermediates between banks and the public, so you could exchange money with these companies, and you get a better exchange rate than doing it with the bank, because basically this currency firm would put everyone's currency trades together and get a better deal on the exchange rate. So you could get, like, at the time, the banks used to charge about 4% to change your money, and these currency houses were offering between 1% and 2%. So you could save 2% on the exchange rate. So it's really aimed for people that are transferring 2,000 euros, pounds, or dollars and above. That's because they made savings on that. So it was a friend of mine, and I went there to oversee project management of build these databases, websites.
Okay, excellent. And so how did you go once you kind of made the decision that this was something that interested you and you wanted to pursue it further? Like, what happened from there, and how did you go once you started to get into trading a little bit more?
I think I followed the path of a lot of retail traders, as in buying a system off the internet and paying for poor quality courses, basically because I didn't really have enough knowledge to understand what I was looking at, whether I could value, if it was good value for money. And, sucked in a bit by the sales pitch of that all you needed was a system and you'll be rich. I soon realised after about a year that wasn't really going to be the case. I then started looking for a system and trying to get myself organised rather than just a get rich quick scheme. So that was how I started, and I made all the mistakes that a lot of retail traders make mistakes, because a lot of the times people just really haven't got the information to make good decisions, and I was looking for shortcuts. But after trading for 6 odd years, about 2 to 3 years in, and realised that the shortcuts I was looking for, trading systems, setups, and edge, actually are the wrong shortcuts that I should have been looking for, and I think which most beginners shouldn't be looking for.
Okay, so would you mind elaborating on that point, maybe a little bit more about some of the shortcuts that you think we should be focusing on, if we should be focusing on shortcuts at all?
The average retail trader that I've met and myself, are looking for setups and systems to start with, because they think that's the best path to follow to profitability. But in the first 2 years, 3 years, and really, I was nearly profitable before I actually realised this, that out of all the profitable traders I met, whether prop firms, ex-retail, we all traded different systems or different setups. And it suddenly occurred to me that the common link between all the profitable traders wasn't that they were trading just one way, they were trading a variety of systems. Actually, the common link between profitable traders is actually not their edge, is the way they approach the whole business of trading. So they knew how to, evaluate an edge, how to they understood probability, how to review, how to change the systems, and how to process stuff. So the thing in common was just how they approached the business. So if I was decided then the best way to replicate and to turn profitable was not actually just purely focus on finding a profitable system, was to replicate the work ethic and the principles of all the rest of the side of the profitable traders, i.e. process, how to evaluate a trading system, because we buy these trading systems off the internet or you follow someone, and most of the time we don't know how to honestly evaluate whether it actually has a trading system has an edge.
Okay, and when you came into trading, when you first kind of got started, were you doing this, did you sort of jump into trading full time, or was this something that was sort of a side hustle while you were continuing to do this contracting work?
To start with, it was a side hustle. I was doing it part time in the evenings. And one thing about myself, I know that I'm not particularly good at focusing on two different projects at the same time. So that I found that either I was focusing on the trading and my project work was suffering, or I was focusing on the project work and the trading was suffering. So after about a couple of years, I wasn't really making much progress. So I decided that if I was going to make a go of trading, then I would have to stop doing the project work and focus on the trading, which then meant that I'd sit down with the wife, we had to sort out our finances, and basically she was going to have to support me until we got profitable. And we'd have to make fairly drastic cutbacks in our lifestyle to support that. So that was a decision we made as I went full time. And then it took me about probably 18 months after that to get profitable on Forex, but I was trading the daily time frames. And I found whilst I was profitable on that, I couldn't really make a living because I was undercapitalized. So after about a year of trading Forex, I decided I was going to move to futures really to get more opportunities. And then once I moved to the futures market, I realized that whilst my system, I was trading the same system, had edged the market, that the rest of my decision making or how I approached the trading wasn't robust enough on the lower time frames. On a daily time frame, I would have hours to make a decision and watch the markets, but then when I was going down to the 5-minute time frame, you might only have a minute to make the same decision. And I soon realised that my whole process and decision making approach wasn't robust enough for that time frame. So I was a lot more inconsistent, made a lot more discretionary errors, and it took me a while to get to grips with that and to get on top of that.
Okay, so I'd just like to back up a little bit to when you sat down with your wife and you had that discussion about when you were going to step into trading full time, and at this point you weren't profitable. I mean, what did that discussion sort of go like? What were some of the things you talked about? Did you have sort of, in a sense, goals that you wanted to hit profitability within 12 months? If you didn't do that, you were going to, pack it in and go back to work. I mean, was there anything like that? Did you set any kind of milestones that you wanted to hit right at the beginning there?
We had one milestone that if I lost 50% of our money, then we would reassess whether this was a viable option for me, and that was it. But we both just had a belief that, one thing my wife knows about me and myself is that a tendenicity that, if I approach something, either they'll do it or they'll go in the back garden still trying to do it. So if I say I'm going to do something, then I will do it sooner or later.
Yeah. I mean, you must have been pretty confident in yourself that you were going to be able to do this. I mean, it's quite a big decision to actually jump into trading full time, especially at a point where you're not profitable, I think. So, I mean, props to you. It's obviously worked out well. Yeah,
it is a difficult decision, but at the end of the day, that I left the career in the city to go sailing, which was unpaid at the time, when I was working as a management trainee for a big shipping firm, and all my friends and family thought I was nuts for doing that. So thinking I'm going to fail or it's going to turn out, it's never been a problem for me, because I think that I'm always going to. The worst thing someone can tell me is I can't do it.
And I think, often often people are kind of scared to take a risk like that. I'm not saying you should just go out there and quit your job, to whoever's listening to this right now, and just jump into trading full time. But often people are actually already living out their worst case scenario. You know, people are always scared about if they take this risk and they jump into something, what if that fails and what if it doesn't work out? And even if it does fail and it doesn't work out, the likely scenario is they're going to go back to what they're doing right now. So in most cases, many people are already living out their worst case scenario. But, just moving on from this, during that kind of that 12 months, 18 months, how did you deal with information overload? Did you feel as though there was an overload of information? And, how did you do your best to avoid going down dead ends?
To be honest, to start with, you have no real way of avoiding the dead ends because you're so inexperienced in the market, or I was so inexperienced in the market. You have to go down a certain amount of dead ends to realise they're dead ends. And as you go down the dead ends, you start to recognise dead ends, so you get the experience not to go down them. So one of the mantras that, and I've got this from FT and a few others, that I just learned to accept that what I've done in the past or what I've done up to now, I can't change. It's what I now do from now onwards because, there's plenty of dead ends in this business and some you just can't avoid. Some you can by focusing on I call them shortcuts, but focusing on the right areas so you can evaluate edges or evaluate the information out there. But as a retail trader, you need to just focus on one thing at a time because there's so much information and so many areas to do well in. You need to just split them up and take it in small steps.
So would you say that there was any kind of definitive turning point in your trading career?
My definitive trading point was because I used to do a lot of racing, used to do a lot of tracking and performance analysis. So as soon as I started trading, I started tracking my trades, and I wasn't profitable when I was tracking them. And then it suddenly occurred to me that if I wasn't consistently following my rules, so my own process or making loads of errors, then actually the trades I was taking were slightly random or random trades. So all the stats I was doing on my random trades were random stats. So while I was trying to analyze and review them, I was just reviewing a bunch of random stats. So the value from these stats was virtually zero. So I stopped tracking everything and went back to tracking just my consistency and errors, because I went through when I thought about that and realized, well, if I'm not consistent, then I'm just tracking random. So I went back and looked at like the last, I can't remember how many it was, like 50, 60 trades, and like 50% of them had errors in it. And then looking at the old trades, once I removed all the errors, I went from a losing trader to actually a slightly profitable trader just by removing the errors. And that's not even approaching looking at the consistency side. So what I did was then just start tracking errors and my consistency in following my rules. And by working on that side, that turned me from a unprofitable trader to a break-even trader to a slightly profitable trader. Just by focusing on them areas, that's without trying to optimize my system or work on the system. So that was a key turning point for me.
Right. And what were some of the errors that you noticed you were doing most regularly?
Not taking trades that are in my system, taking trades that wasn't in my system, being early, so a lack of impatience. So I've got an area where I set up, but I enter early before my checklist was complete. Missing the entry and then entering late. Breaking my trade management rules. Putting the wrong targets in, wrong stops, made all them sorts of errors. Some more than others, and the first couple were the majority, so that was really an order of how often they occurred for me.
Okay. I like the point you bring up there about how, you were tracking your trades, you were doing the right thing, but, the trades you were tracking were trades that were outside of your strategy that you should have been trading. So you were essentially tracking randomness. I think that's a really interesting point, and I'm glad you brought that up. Talk to us about how you're trading these days. Give us the rundown on your approach to markets now. I mean, is it any different from when you first got started?
Yeah, completely different. I can't even remember the system I traded when I first started, but I trade supply and demand, which was originally, I learned that from a course from OTA by Sam Seiden, and the way they teach it is freely available on the internet. But what I've done is altered that to sort myself by using volume profile. So I use sort of supply and demand to find areas where I think there's trap traders or traders wanting to get out and in, and then use that to take my trades off.
Okay, and what markets are you trading?
Trading the Bund is my primary market. I was trading Euro stocks, but I've swapped Euro stocks and I'm experimenting with the DAX at the moment as a secondary market.
Right, and you're trading intraday?
Intraday, yeah. So my big picture is 60 minutes. My medium picture is 15 minutes, and I trade off the 3-minute chart.
Okay, and if I understand correctly, I think you mentioned this a little earlier. You started out as more of a swing trader or maybe a multi-day trader, but you've since gone to the intraday time frame. I mean, what sparked that change?
The spark that change was the fact that it would take me, compounding my account, it would take me over 10 years to actually earn the same sort of money that I was earning while sailing. So my wife would have to support me for 10 years, and I would then only then through compounding, because I didn't have loads of capital. I was very careful with the capital I had. Obviously, sailing is a lot better paid now, so funny enough since I've left. But at the time, sailing wasn't particularly well paid, so I didn't have loads of capital. And that was the main reason to change from trading the daily to the intraday, was to maximise the number of opportunities, and whilst trading the same amount of risk relatively on the intraday, it just had more opportunities, thus more opportunities to compound my account.
Okay. Yeah, I can see how that makes sense. And now the markets you mentioned there that you trade, out of all the markets available to you, why do you trade these select few markets? Is there any reason?
Yes, there is. When I was trading Forex, I was looking to move to intraday, and I was starting to experiment on Forex markets intraday. I went to a party, and one of the crew I used to sail with worked for, I can't remember what bank, but she worked for a bank. And there was a couple of prop traders at this party. Didn't know each other, worked for two different firms. I can't remember what firms they were, because it was quite a few years ago. I was talking to them about trading, and none of them traded Forex. And no one in their firm traded Forex. They traded the odd currency market on the futures, but they were, secondary trades at best. And everyone was trading, either the ES or the Bund or the Euro stocks or the DAX. And I thought, well, everyone in retail is trading Forex, and it seems all the pros are trading completely different markets. And then through Tom Dante was talking about his experiences at Prop, and it was basically the same thing, that no one was trading Forex as a primary market. And I think he said one person was trading Forex as a primary market, and there was the least profitable person at the firm. And I thought, well, there must be something in that retail are trading Forex and the pros are trading different markets. So if I wanted to be a pro, I should be trading the same markets as the pros trade.
Okay, so why do you think that is, that less of the quote-unquote professionals trade Forex compared to other futures?
To be honest, I'm not too sure. I mean, I wasn't having much success on the lower time frames in Forex. To be honest, I'm not 100% sure why they don't. I mean, I'm not sure that the Forex on the lower time frames are slightly more random, or there's more games played, but I think that the pros I've met are using a lot more volume profile, and that's obviously easier available on the futures market because there's no real central exchange on the Forex.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT funded with up to resources.
As well as kind of a secondary market to what you do. What are some of the things you've done to get familiar with this market? Like, as someone who is, a profitable trader now, you've seen some success. When you introduce a new market to what you do, what are some of the first things that you actually do to familiarize yourself with that, in this case being the DAX?
The first thing I did was I keep about 15 to 20 standard stats on the market I trade. So the first thing I did was draw up the same stats for the DAX market. And then I had the charts open for maybe 2 weeks and just watched it, see if it reacted and drew my lines and done just have a process how I analyze each time frame to find areas of interest or areas where I buy and sell. And so I did the same analyst dropped the same trade plan for it, but I didn't actually trade it. I just then watched to see if it kind of reacted the way that it would to my system. And then I started trading it using one lots, just to see, where the buffers need to be, how much I need to front run levels, how easy it is to get filled, and just really experimenting with how it reacts to my system and what change I need to make to my system to deal with the DAX market, because obviously the DAX is a lot thinner than the bond market and the Euro stocks.
Okay. Now, you've used the term system a little bit. Let's just get very clear on this. How much of what you do is discretionary versus rules-based, just so we understand where you're coming from here?
Well, basically, I couldn't code my system, but it's very much process-based in how I make my decisions. So it's a discretionary system, but it's very rules-based in how I make my discretionary decision. So I have rules for how I analyze the charts, how I find the areas of entry, what I'm looking for. So I have a checklist and cheat sheet for how I analyze, find setups, and depending on the strength of the setup, according to my processes, what sort of targets I'm looking for. So whilst it is discretionary, it's very much rules-based in how I make my discretionary decisions.
Okay, so what are some of the discretionary aspects of your strategy or your system? Is it mainly actually deciding which trades you're going to take and which trades you're going to let go, or is there something more to it?
Yeah, it's basically, if I have an area of interest, there's basically either there's a trade off it where I'm just going to put an entry in, so when it comes back it fills, or if the level is area of interest but it's not strong, then I'm looking for a trigger. So then I'm looking for a checklist of about 4 items, which I need at least 2 of them to enter that trade, or it's an area that I don't take a trade. I have to wait to see for new structures to form in there.
Okay, and once you do get into a trade, how do you determine your position sizing? I mean, is it always fixed? Is it the same for each and every trade, or does it vary somewhat?
It tends to be fixed because my stops tend to be roughly about the same. But if the level's wider than normal for that market, then my position size will decrease, so that I'm always risking approximately the same amount of account each time.
Okay, and as you mentioned stops there, I'm keen to ask, how do you actually identify where you will place your stops for each trade?
Because I'm looking at on volume profile for areas where I think there's a bunch of traders that either want to get in or want to get out, then my stop will go on that 2 ticks on the other side of that. So on the bund, that can vary between 5 ticks to 10 ticks, but it's averagely between 6 ticks.
Okay, so your stop placement is based upon the volume profile and not where the actual, not a price chart. Is that correct?
Yeah, but the volume profile on the price chart, yeah.
Okay, so you do factor in the price chart to where your stop will go as well.
Yeah. Well, I look at the price chart because the volume profile could be at the extremity of a high. So it will typically go 1 or 2 ticks above the high because that will be the other side of the HVN I'm looking at, or the rotational point.
Right, okay. All right, well, Adrian, let's talk stats. I mean, I've been really keen to speak with you about this. I'm really interested in this for personal reasons, of course, and I think it's going to be very interesting for many listeners to hear about how you use stats in your trading as well. So let's just start right there. How do you use stats in your trading?
I do about 20 stats, and for example, gap fills. But one of the problems I had with stats is that you could have 82% chance there's going to be a gap fill, but to be honest, the 82% chance of the gap fill by the end of the day, we could go 100 ticks offside, then come back and fill the gap. So you're trying to work out, whilst it was a good target, we're trying to work out where you enter to take advantage of that stat. So I ended up, not really being able to take advantage of the stats. So what I do now is once I've worked out a stat, and let's say, for example, it's a gap fill on the Bund, that I ignore. It's got a gap above a certain size. So anything below 0 to 6, I'm not interested in, because that affects the stats. Because the original stat I had, I think, was 92%. But if you take out the 0 to 6 ticks gaps, then it comes to, so I'm looking at a range of a gap between 6 and 15 ticks. It has an 82% chance of filling. So what I then did was look at all the stats that filled that gap, that fell in that range, and then looked how far they went offside. So then using that, you look at the curve on that to find out what was the most common, how far they went offside, the most common price, and the standard deviation, what 70% of them did. So that gives me, for a gap up, that the most common offside is 11 ticks, and the standard deviation is 17 ticks. So if I get to gap up between 6 and 15 ticks, I am now looking for trades between 11 and 17 ticks for the gap fill. If it goes above that, then I know that it's more, whilst it still can fill, it's more unlikely to fill, and I'm not that particularly interested in that stat anymore, if that makes sense.
Yeah. No, it does. How do you actually get these stats that you want to know? Like there you mentioned some stats on gap fills. How do you actually find these? Do you use Excel? Do you have a programmer? I mean, tell us a little bit about how you actually get these numbers.
I used to use Excel, and it takes, to be honest, if you've got a fair bunch of stats, it takes forever to do them. I use RT Investor, the platform, and the beauty of that is that you can, and they have a whole homework section on their website, on RT Investor website, and you can drop the charts which will actually give you them stats by putting indicators on there that will give you those stats by programming in their language. And I'm not particularly good at programming, but what I did was, in their homework section, I downloaded some of their charts on stats, looked at how they were done, reverse engineered them until they did what I wanted them to do by trial and error. So now I have a chart which I update my stats every month that I call up for each of my 20 stats, and it tells me what the updated statistics are. Then I fill out a cheat sheet, and that's how I do my stats. And that's how I can keep up to date with 20 stats. If I did them all by Excel, to do 20 stats would probably take me 2 to 3 days and lots of tears.
Okay, yeah. So this is something that the functionality is built into the Investor RT platform, is it?
Yeah, it has the capability, and they have loads of tutorials to teach you how to get that functionality out of the charting platform.
Right, and you mentioned that you get the updated numbers each month. What is the data sample in the stats that you're using? Like how many, how large is the data sample? Like, is it a moving window or is it sort of cumulative data?
It's a moving window, and the size of the moving window is dependent on the stat. So the typical moving window for me is 1,500 days. Some of my stats, which I'm trying to capture what he's recently doing, is like the size of the swings. I do on the lower time frames. I run a 30-day rolling window.
Okay. And do you find that certain stats are less reliable in certain types of market conditions?
Yes and no, because in the day the stats are the stats, and you have to take in context. And that's why I've done the maximum adverse excursion on the majority of my stats to find out where it's, if it's going to fill, how far offside 70% of them go. So then it gives me a clue that, if it just punches straight through that, then it's unlikely the stat's going to be fulfilled. So I'm not particularly interested in that trade, because you could get situations where the stat's open, but the price is going one direction away from the stat to be filled. And you're sitting there wondering, well, is it going to fill or is it going to fill? So by using the maximum adverse excursion technique, that once it gets past a certain level, I won't be interested in that stat again unless it comes back towards the gap fill, and then gives me a setup in that direction. So I use it as a qualifier, and it gives you a clue of the strength of the market.
Yeah, would you mind explaining maximum adverse excursion?
Yeah, maximum adverse excursion is what I use, is saying that if I have a stat saying that it's going to test the volume point of control, then I look at and that stat is 65%. So I look at all the times that it did test the point of control, and I look at how far it's gone, the maximum it goes offside, so maximum adverse excursion away from the open price or whatever point I'm measuring from. So that will give me, out of all the trades that fill, it gives me an idea of how far it's going to go away from, so if I took the trade as soon as the stat become viable, how far it will go offside. So I don't just take the stat when it becomes viable. I just use that to give me a gauge of how far it might go away before filling. And if it goes further than that, then I'm not interested. So that's what I call a maximum adverse excursion before the stat will fill. Does that make sense?
Yeah. And on the other side of that, the maximum favorable excursion, is this something you also look at, maybe in terms of profit targets or something like that? Does that come into play in your analysis?
It comes into play in my analysis for my own trades. I track maximum favourable excursion and maximum adverse excursion in my trades after I exit, to see to monitor how well I'm placing my targets.
Okay, and is this something that you can track in Investor RT as well, or is this something? Do you have an Excel spreadsheet that you track this in, or do you manually do it? How do you track this?
I track it manually, and I put it in a spreadsheet, and then I put loads of Excel sliders on it to so then I can break down the information into long, shorts, or whatever. Now, I did a post on my blog showing you the readers how to set one up, and I think that actually I put the Excel spreadsheets up there as well. So there's a video actually how to make your own MFE, MAE tracker.
Yeah. Okay. I'll dig up a link to that, and I'll make sure to include that in the show notes, so anyone listening to this can find out more about that. I think that's well worth your time. We were talking a little bit before we hit the record button, and one of the things you mentioned is that traders sometimes use stats in the wrong way. Would you like to share, maybe an example of how traders may use stats in the wrong way?
Well, it comes back to what I was saying before about that. If you have a stat that's going to do something by the end of the day, it doesn't really. So it might give you a context and it might give you a target, but it doesn't give you an entry. So you don't know if there's a profitable edge in that stat until you do more research, because it's a stat by itself saying that I have a stat that initial balance range, one side will be tested 98% every day. So virtually every day, one side will break. But by itself, it's not much of an edge because it could be either side, and you don't know where your entry is. So you don't know what your risk reward is. So even with a 98% chance of breaking either side, whilst it gives you a target, it doesn't really help you find an entry. So that's why I think that a lot of people focus on the wrong side of the stats to get the stats, but they don't really know how to turn that into a profitable edge.
Okay. So once you have a stat which seems kind of interesting to you, what's the next step you do with that? Like, when do you decide whether that's something you're going to factor into your decisions, or whether it's something that's just, I guess, essentially noise, like there's no edge in knowing that? What's kind of the next step you do once you discover a stat that grabs your attention?
What I do is, the first thing I do is actually, the only interesting stats are really that are above 65 to 70%, because you can have too many stats, and what I want is stats that are a high probability. If they're under that, then I'm not that particularly interested. And also that I'm not that particularly interested if it's a stat that's going to, generate only 2 or 3 ticks of profit. So I'm looking for the stats that have got a decent amount of profit in them, or potential profit, using common sense I can actually use within my trading. Because some stats that you come up with, like the IB high, I use that stat all the time, knowing that one side's going to break, but it's not a major part of my, it's part of my analysis, but it's not, I don't take trades going, well, it's going to break one side. I would be looking going, well, I think this is an area where buyers are going to step in. Then I'd go, well, where's my target's going to be? Well, the IB high hasn't broken yet. We're due to break one side. Buyers are going to step in here, so that's an actual natural target.
Mm-hmm. Okay. And just to clarify for anyone listening, if you're not familiar with what IB is, it stands for initial balance, which is the opening 60-minute range of the regular trading hours session. That's correct, isn't it?
Yeah, I use a 2-hour on the Bundo.
Oh, okay, right.
But on all other markets, it's 1 hour.
Yeah. Okay, Adrian. Well, I'm really keen to ask you about how you create a trading plan for the day ahead. I know you post this on your Twitter feed, obviously on your blog, which you link to on your Twitter feed. How do you go about creating a trading plan for each day? What's included in it?
Well, I started with the weekly, which I do at the weekend. Have a look at the weekly charts to see if there's anything obvious. I have a process for every chart. So every chart I will draw in, highs and lows that are significant to me, any flip zones, and then using my same system, I draw in any areas where I think there's buyers or buy areas or sell areas. So I do that on the weekly to get just an idea of what's going on, even though I don't factor in, just to give me an idea of what the overall massive picture is. And then I do the same on the daily. So each day I look at the dailies to see if there's any breakout failures of inside days, which may give me a bias for the next day. And then my main analysis is done on the 16 and 15 minutes. So I look at what the 60-minute bias is, trend, whether it's in balance or is in a range or is actually trending, how strong the trend is. And then I ask myself, what's likely to hold if this trend's going to continue? No matter whether it's not a case of whether I think it's going to continue. The first thing I do is ask myself, if it continues, what should hold and what should break, and where I think it should test. I do the same on the 15 minutes, and then from that, then I draw up a long scenario, neutral scenario, and short scenario. So, and that's really how I just work down. I just work down from the 60 to the 15 minutes, looking at the daily just for overall bias, and analyze them both in the same ways, and just work out what I think should hold based on my, if it's in a trend or if it's in balance. and what should break and where it should test, which then gives me an idea of where I should be taking trades and red flag areas. So if I think that it's an uptrend and it should break the high, next day if it doesn't break the high, then that gives me, or is struggling to break the high or breakout fails, then that gives me an idea that the trend may not be strong enough. We may have a change in behaviour in the market.
Right. And one thing that often comes up that traders mention that they struggle with is actually not doing up a plan, but once they do up a plan, they actually struggle to stick to it and follow it through. Is that something that you were ever challenged with, or had that always come fairly natural to you considering your background in sailing and being very process driven for a good part of your career?
I've definitely found it a lot easier to follow my plan when I was trading dailies. That was a lot easier. Intradays, I struggled with that a lot. And the way I got round it was to draw up what I call mini plans. So I really drawing up 4 or 5 times a day what it's done since the open and where I expect it to test. So then I can use that to then look at my daily trade plan to see that, saying that if I think an uptrend but it's going down, then I draw up my plan and look at the 60-minute. So I kind of run a mental model of what's going on at the time, so you see how it fits into my major trade plan. So I have these little mini plans. So I trade around the mini plan until I get to my major plan, and then I trade around my major plan.
Mm-hmm. Okay. And I mean, I'd suggest if anyone's actually interested in seeing how Adrian goes about creating these plans, to definitely check out your website. What is your website, Adrian?
Takingonetradeatatime.com.
Takingonetradeatatime.com. I'll link to that in the show notes, of course. At the end of each week, I noticed that you review the week that's just been. How do you go about reviewing your trading week? What's that process like, and how has this been helpful for you in your development?
Well, the key thing is to be honest with yourself. Honest with myself. That's been the key thing. Process is one thing, but actually, no matter what process you put into place, if you're not being truly honest with yourself, and to be honest, we used to have review processes when we used to do sailing, and the one thing I've noticed with myself and the majority of people that when you're doing proper reviews of performance is that people really don't like being that honest with themselves. They don't like to admit that they've made a tit of it, and that is to be the key, because no matter how you approach it or what your process is for your review, if you're not really being honest about the reasons why that it's going wrong or it's not going the way you want, then you're not really going to get any answers. So the key part of the review process for me is the question why, and to keep asking why am I doing that until it makes me uncomfortable, because normally once you get to a really uncomfortable place with asking why, you're normally going to get to the answers. But the actual physical process is that the first thing I do is I do a chart review at the end of each day. So I mark up all the areas where I took trades, make notes of them, areas I missed just because I didn't, or interesting things on the chart. So the first thing I do at the weekend is go through all them charts at the end of the day, market reviews. Then I go through the stats for the week and see where when my results are in variance, how I'm doing against my goals. Look at the number of errors, look at the number of missed trades, compare that to the week before to get an idea of whether, I've had an increase in errors or missed trades, etc. So I started taking all them notes down, and then I go through my mini plans, because next to my mini plans, I'm writing down what I'm feeling or what I've done wrong, and also I make them notes in the market reviews, and then it gives me an idea where I haven't particularly performed well in that week, and what I've done good. And also I also grade my trades. So I go through the weekly grades and look for areas where my grading wasn't particularly good. And I also grade my days, the sessions for my focus. So I go through them areas and look for areas where I've scored lowly, and then go back through my notes and look for things in common, why that was happening, by looking at my mini plan. So that gives me 2 areas. I normally just trying to focus on 2 areas. One where I did well, so I'm not constantly beating myself up for doing shit, and one area where I did shitting, and then I go, well, I did shit. Well, why did I do shit? Why do I have what's causing me to do shit? What's causing me to, try and work down to the original cause? So I just keep asking myself why, so I can go down and find out really. And normally, to be honest, most problems with not following the plan or making fuck ups comes down to 2 things: fear of loss or fear of missing out. And then there's others where you're not focused or tired or you're distracted. But really, most of the stuff really comes down to the 2 fears.
Right. So how do you actually grade your trades? Like when reviewing these, how do you determine what's a good trade and what's a bad trade?
It changes over time. Hold on, let me just open my spreadsheet so I can tell you exactly. So off the top of my head, I'll probably get it wrong. First thing I do is that, and each of these are weighted in different scores. So what's more important? So the first one I grade it on is it in my trade plan? And I have a score between either 0, wasn't in my trade plan, or 10, it wasn't my trade plan. Then I score it for was I playing to win or playing not to lose? Because I do have a tendency to play not to lose. So take profits quickly rather than let them, as soon as I see a bit of trouble, get out of my trades rather than let them run to targets. Then I score myself for whether I was emotional in the trade or whether I was patient. So how I was actually feeling. I score it on whether what the risk reward was like, whether it was high risk reward, medium risk reward, or the risk reward was, if it's under 1.5 risk reward to the first target, I shouldn't be taking the trade. So I score that. I shouldn't be taking the trade because it was rubbish risk reward, or it was an okay risk reward, i.e. 1.5 and above, or if it's above 2, then it gets high score. I also track intuition, and that's really just to see that whether my gut instinct is right or wrong. So it's part of my grading, but it's something to track. So if I feel that my system says take the trade and my gut says no, then I score that low. If my system says it's an okay trade, but my gut says yes, then that gets a high score. So that's really our ongoing project to see how well my gut instinct is working. I then grade it on entry, whether I was entered when I should do, I was a bit late, a bit early, and how I managed entry. Then I grade my exits on the winners, and I grade my exits on the losers. And then I divide that by the total number of points to give me an A, B, or C, D trade.
And we can see all this on your website, right?
Yeah, I've talked about my grading system before, and I got that idea how to grade the trades from Breaking Out Bad. At Breaking Out Bad, he's a trader on Twitter, and he has a whole screencast on grading days and grading trades. So I saw that and I added that to my system.
Excellent. And how many hours would you say you spend each week reviewing your trades and, doing homework and this type of thing? A few?
20.
Outside of market hours?
Yeah.
Okay.
Probably.
Wow.
Probably slightly less than summer because I go sailing on Tuesday and Thursday. So my evening reviews tend to be I either don't do the evening review totally, market review. I will do my market prep, which lasts between half an hour and an hour, depending on what's happening in the markets. So that in the summer, twice a week, I probably do an hour every evening. But during outside the sailing season, I'm doing between an hour and 2 hours every night. And then I do 11 o'clock to 5 o'clock on Saturday, and about 11 o'clock to 5 o'clock on Sunday, most weekends.
Right. Okay. That's really impressive. Wow.
Well, my friends say it's sad.
Well, you got to do what you got to do.
Exactly.
Let's just do one last question, just for fun. What's one thing you wish someone would have told you before you started trading?
The mental side goes hand in hand with the trading edge, and more importantly is that trading, and I didn't realise this myself until halfway through my my career so far, if you want to call it a career, is that trading has actually got loads of similarities with competitive sport, as in like cycling, boxing, individual competitive sport, as in what you do outside the session or the event counts just as much as what you do inside, but you still got to perform whilst doing the event. So if you was a boxer, if you didn't do any fitness or any skills practice, no matter how good a boxer you was, you would still do rubbish when you come to a boxing match. So, and trading's the same. But I didn't realise right at the beginning that how focused and processed you need to be in the prep side and your homework has such a big effect on the how you do actually in the trading session. And I think that's one of the biggest problems with a lot of retail traders, because I speak to a lot of people. I'm at stage 5 and I speak to people there, and over the years I've spoken to a lot of traders online. I've seen majority come and go, and it was a problem with myself to start with, but I see all the time is that the prep is never given the same weight as the trading sessions, and actually it should be given equal weight, or even more, at times more importantly. If you're not prepared before you go in there in how you're going to approach the competitive event, then you're not putting the odds on your side, no matter how well you trade in the competitive event. And I wish I'd known that in the beginning, because I would have definitely put more weight onto how I'm doing it now, the prep and the homework and the research and review process right at the beginning. And to be honest, I think I would have knocked at least 2 years off my progress.
Right. Yeah, no, I think that's really good advice there, Adrian. Where's the best place listeners can go to find out more about you?
I'm on Twitter at APR17, and I have my blog where I post my trade plans and my weekly reviews, and I try and write articles on my process and basically stuff that interests me on that. Taking one trade at a time.com.
Okay, and would you mind just spelling out your Twitter handle, please?
ADEYF for Foxtrot 69.
Excellent. Well, Adrian, I'll include links to all of these, your Twitter handle, your website, as well as the maximum favourable excursion and maximum adverse excursion links in the show notes as well. So, Adrian, man, I've really enjoyed this. Thank you very much for agreeing to do an interview, and I appreciate your time.
No problems, mate. It's my pleasure.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, Trade the Pool funds home-based stock traders with up to $200,000 in buying power. Join the stock trading revolution today.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome. What's up? How you doing? Welcome to episode 95, folks. I'm pleased you could be here, and let me briefly introduce my guest, then we'll jump right into the interview. So, this week I spoke with Nico, who asked me to keep his last name private, though he does go by @InefficientMRKT on Twitter. Put simply, Nico is a day trader with a thirst for momentum. He predominantly trades low-priced stocks that have a tendency to move fast and far, and roughly 90% of his positions are on the short side. But the main reason why I brought Nico onto the podcast is I feel as though he has a really interesting story which many traders will be able to relate to on one level or another. The short of it is, Nico placed his first trade in 2007, made 4x on his starting capital year one, and then slowly bled his trading account for the next 7 years. He's now found his groove, but his overnight success was 8 years in the making. The subjects we discuss during this episode are very much centered around Nico's journey and development as a trader, and how full-time trading became more than just a pipe dream. Please enjoy, guys. I'm Aaron Fifield, and here is my guest, Nico. Nico, what's good, man? What's going on?
Greetings. How are you?
I'm doing all right. How about you?
Great. I just spent the day and I set up my new war rig. I got
nice.
two 43-inch screens. I had to buy a new table for my desk though because they wouldn't fit before.
Trader problems.
Yeah.
Nice. 2 43-inch screens. That must be massive.
They are so cool. They're Dell's new multi-clients, and you can divide them into virtual screens. So even though I have 2 physical screens, I have 12 usable virtual screens.
Okay. That's really cool. What were you using before?
I had 4 24-inch screens and 28-inch vertical, like in portrait.
Yeah.
That I was using before, but this is much more. This is way better.
Oh, that's awesome. I imagine it might take a little bit of getting used to. Yeah.
It does. It was actually a gift from my girlfriend. She got me greatest gift of all, man. She got me one of these beasts for my birthday, and I wanted to use it, and my computer at the time was too slow, so I used that as an excuse to get a new machine that could power it. And man, I started using it, and I loved it so much. I was just like, I just need one more of these, and that's all I need. And I ended up getting rid of all my other older monitors.
That's very cool. And what's the resolution on those? Are they 4K?
They are 4K, so you get the standard 3840 by 2160 for each one.
Okay. Nice, man. I like it. You'll have to share a photo with us.
Definitely. I plan on it.
And how'd you go with the desk? Did you find a desk that fit?
Gosh, I was almost resigned to the fact that I might need a custom desk, because these 2 monitors next to each other are about 76 inches wide. Mm-hmm. And I was hard pressed to find a wide enough desk that I could put both of them on without, a ton of monitor hanging off the edge and it looking funny. But I found one desk at IKEA that fit the profile, and I just mounted it to my elevator desk legs, and we're good to go. Okay.
Good stuff, man. Good stuff. Yeah, well, I look forward to seeing a photo of it.
Thank you.
Well, before we go any further, I want to say congrats on having a really good month in August. I think that was your best month to date, yeah?
It was. Thank you very, very, very much.
You must be stoked with that.
It feels amazing. Yeah, it feels really good.
Cool. All right. Well, I know a little bit about your story, Nico. And what I do know is that it's going to really inspire a lot of people who are listening to this podcast right now. So I'm really excited to have you on, and I'm looking forward to, the conversation we're about to have. So let's get this underway. Take us back 10 years or so, right to the very beginning. What got you interested in trading? Where did you start?
I was working for a small boutique software development firm out of high school, and I was developing software. And the short story goes, I wanted to make more money, and the owner was reluctant to pay me more money because he held it over my head that I dropped out of college, and I then had to decide whether I wanted to go back to school or go into business for myself. And I wasn't too fond of school at the time because I wanted to take computer science classes and whatnot, but they wanted me to take all these other classes, all these other courses I had a hard time taking. So I decided I didn't want to go back to school. So I went into business for myself, and I knew computers. I knew how to develop software. So I started building my own business from nothing. And one of the very first clients I had traded stocks, traded equities. And I heard of the stock market before, but I never had much interest to the degree that I would actually do something about it. But to finally meet someone in my life that was familiar with it, that was a good starting point and gave me good exposure to it. And once I understood the kind of money that could be made, that definitely held my attention.
So how did you find out that this guy, this client of yours, traded stocks? Did it just come up in conversation, or how'd that come about?
I eventually got comfortable enough to ask, hey, where's some of this money come from? And that was basically the answer. To have someone that you see you respect and who's doing well for themselves, and to ask them where their money comes from, and that's the answer. That was enough for me to finally start getting very interested in it and seeing what I could learn about it.
Okay, so it was obviously quite clear to you that he was doing quite well. I mean, was there any hints that sort of gave it away? Was he a high-paying customer? I mean, what sort of gave it away that he was doing quite well?
Yeah, I was definitely making more from having him as one client alone than I was working at my software company that I worked for 6 or 7 years. And he was just my very first client, and I knew I had to charge more than I was making at the software company, but it was a great situation for both of us, and I got compensated well, and I got to learn a little bit. But what I learned from him, it was very different than what I was ever really interested in the sense that he would trade big cap, large cap stocks, and he was interested in Dow Jones components and whatnot. And I just, once I understood what volatility was and I had a sense for it, watching those stocks move 1%, 2%, or 3% in a day, 3% is a big move for stocks like those. That wasn't very interesting to me. But when I found out about cheaper price stocks, that was wow, these things move 10, 20, 50, 100% in a day. That was much more interesting to me.
Okay, so it's almost fair to say he was probably more of a longer term guy, or a bit more of an investor, yeah?
Definitely.
Okay, cool. So walk us through your first year, like from when you became interested because of your client there until about 1 year on. So I think it was about 1 year before you actually placed your first trade with real money. What was going on inside of that year?
I was trying to learn as much as I could, and I was also going from when I was a software developer, I was living paycheck to paycheck, and I had no savings at all. So for me to try to start out with something in the market, I had some, not only did I need to save money, but I had some I had all these habits that I had to get in check for living paycheck to paycheck. Once I started having some income, decent income, I had to, at first I got excited and I was, probably spending more than I should have. But after a while I was like, okay, this is great having money, but I really need to save some money because it would be great to open up a trading account at a brokerage. And that's kind of where that first 12 months was after I learned about the stock market, was me rearranging some habits and saving some money. And meanwhile, learning, I won't say as much as I could about the stock market, but definitely learning some about the stock market and just kind of trying to be able to stand on my own 2 feet and get something going right from the start. But it took me a while, about a year.
Okay. So I just want to pick up on something you said there. I mean, it's a little bit off topic, but you mentioned that you had to break some habits so that you weren't just going paycheck to paycheck. Now,
yeah,
I know there are a lot of people who do this, and it's kind of crazy to me to think that people do that, obviously, when they don't have to. What were some of the habits that you had to break? How did you break those habits so that you weren't going paycheck to paycheck?
Well, for years, for all the years I worked at the software company, I was paycheck to paycheck. So that means I was, whether I liked it or not, but I was programmed to spend my entire paycheck every month because that's all I needed, every bit of it, to survive, to pay rent, to buy food, living on my own, to, whatever. I was a lot younger, but, I probably spent money on stuff I didn't need to spend it on. But all that, that was a big habit for a long time, 7 years of doing that. So once I finally got some decent income, here I was used to spending my entire paycheck. So after a few months, I think I was spending my new paycheck when I went into business for myself, which, by the way, that wasn't an immediate thing. I made a decision I'm going to leave my software company, but I still worked there until I was able to get something going on the side and generate some, a good chance of possible income on the side before I jumped ship, because I did have bills to pay, just like everyone else, food and rent and whatnot. But eventually it was fine. But the habits thing, it was just, I was programmed to spend money, and it took me a while to realize, hey, just because you're making more money, you don't need to spend it all every month. Like save some and see what happens, especially if you want to, dabble in the stock market. Gotta have some money to play with. It's got to come from somewhere.
Absolutely. And I think when you go into business for yourself, obviously you don't kind of have that same sense of security as you do as a full-time job, where you've got another paycheck coming next month. And when you're out on your own, it's kind of like you don't necessarily know where your next client is coming from, or where your next when you're next going to send out your next invoice or whatever. So
that is the truth, man. Complete truth.
Yeah. I went about it much the same way because I used to run a graphic and web design business, which I kind of built up while I was doing my full-time job.
Oh, nice. That's the best way for anyone that wants to do their own thing, work for themselves, go into business for themselves. Please, do not quit your job and just do it. I definitely think, I'm of the opinion, at least for me, it's much better to keep getting your paycheck from your regular job and try and get something started on the side. See if you can get something to stand up on its own while you still have a job and you still have that paycheck you can rely on before you cut loose, because it makes it so much easier, at least psychologically. For me, it did.
And that can even tie in neatly with trading too. So there's many overlaps there. So do you recall your first trade? Like, how did that go? What were the emotions like when you put on that position? What was it like?
Yeah, my first trade was in early 2007, and I bought some stock in Apple at the time, and I don't know what my time horizon was, how long I was planning to hold it, but I think I ended up selling it later the same day for maybe $100, and I just thought that was the greatest thing ever. I just thought that was the easiest $100 I'd ever made, and that I'll never forget it. And even though it was only $100, man, it stuck with me this whole time, and that was my first taste of it. even though it was just Apple in a big cap stock, a large cap, it was just getting paid that much without, I couldn't even call it work. It definitely resonated with me, and that was the kind of money I wanted to make, compared with going to work, working in a cube or an office, and nothing wrong with that, but it's a different mentality. And once I got a taste of that, I definitely wanted more.
Yeah, I feel that for sure. And I think that's, a lot of people who are attracted to this, I mean, that's kind of what goes through their mind as well when they first come into trading.
Absolutely.
So, I mean, during that first year, what were some of the things you were learning about, about the stock market? What were you reading? Where were you getting your information from?
Yeah, so back then I was using a charting platform called Telechart, and Telechart's by a company called Warden Brothers. I guess they've been around forever. Apparently they had stock chart programs since before Windows. You could get stock charts in DOS. They had a DOS program for stock charts and whatnot. But anyways, I was using their Windows program and started using that in 2007, and it had a built-in chat window that I've always been into chat. When I was a kid, I used to chat on IRC when I was younger in high school and whatnot, and I've just always been big into chatting and whatnot. And to have a chat room with a bunch of investors and traders, man, I thought that was the coolest thing ever. And I got to see what people typed, and who knew what, and that type of thing, and that got my gears turning in all different sorts of directions. And it was really good for me to learn about other people, what they were doing. That helped clue me in. I was definitely self-directed towards technical analysis. I love the idea of looking at a stock chart and just going, okay, I know, do I want to buy this, sell this, or not touch it at all? And that appealed to me a lot more than the fundamental side. The fundamental side was it seemed like so much work. That seemed like having a regular job all over again, because it seemed like you can just pour all these hours and hours and hours and hours of research. Maybe you study something for days, weeks, maybe even months. I don't know. Just one stock or a handful of stocks, and you get to know them intimately and you understand their business. But it just seemed like, at least back then to me, it might take 6 months or a year for the market to realize whatever you may have realized doing your fundamental analysis. And even if you thought it was a great investment and you buy it, I mean, if the market doesn't know it's a great investment, maybe it takes 9 months or 9 years for market to catch up to what you were thinking, if at all. So just timing the market using stock charts, that was, I mean, instant gratification. I love that idea. that was big for me.
Okay, cool. So, we're about 1 year in at this point. You've taken your first trade on Apple. You banked $100. Your interest has been piqued in technical analysis. What was it like moving forward from there? Maybe walk us through the next year or couple years on from that point. What was your experience?
Okay, so for basically my first year since I placed my first trade, for the next 12 months after that, I was attracted to low price stocks, and I didn't even know what shorting was at the time. And I just thought the only thing I could do was go long. So I was just buying all kinds of low price stocks. I mean, on momentum. I mean, any stock that had volume coming into it and it was on a rampage, ripping up, I was buying some. I was chasing it. I was take your pick. I was doing it all. I was doing anything I could to get long and buy some shares. And I don't know whether it was the micro cap market of 2007 or just pure luck, but basically a year of doing that, I made about close to $20,000 doing that my first year, and that made me feel on top of the world. I thought, man, this isn't so tough. I don't understand why everyone says, over 90% of traders fail. This is so easy. Oh man, I'm going to do this the rest of my life. This is a walk in the park. I don't know what everyone's so fussing about. I don't know why they're having such a hard time doing it. This is easy for me. And that was probably the worst thing that could have happened to me, as you could imagine, because Well, I don't want to get too far ahead of your question, but yeah, that was basically my first year. So I had a taste of large success from basically not knowing much of anything. And I think it was just, like I said, I don't know whether it was the microcap market of 2007 or just dumb luck, beginner's luck. But I had a good year in terms of profits.
Okay. Yeah, I mean, that's a really decent first year to have made $20,000. How much capital did you start with?
So my first account I saved up $5,000 and opened up a Fidelity account, and just slowly over time kept saving more money and adding more money to it. But I never really, my first year I might have been a little strong with my position sizes just because I was doing so well and I didn't know any better. But I'm sure we'll get into it. But later on, I toned my size down significantly and kept it in check once I realized I knew that I didn't know.
Yeah. Well, let's get into that a little bit. So the first year you made $20,000. You felt like you were on top of the world and you nailed this trading thing. When did that begin to change? When did you realize that you hadn't quite nailed it yet?
Oh man, probably, I don't know, not soon after, maybe the next month after my first year, a short time after that. I just, everything I was doing that entire past 12 months, it wasn't working anymore. Either my luck ran out and or the market changed, and what used to work no longer worked for whatever reason. And I, unfortunately, thoughtlessly, just continued to be the junkie, degenerate gambler at the slot machine, and I just kept pulling the handle. And even though it stopped working, I just kept doing it. I kept pulling the handle, and I'd say the next 12 months after that, I had lost all of that profit that I made the first 12 months, and I was just kind of left scratching my head the entire way, going, I don't understand why this isn't working. Maybe it's going to start working soon. It must start working soon because, man, I know it definitely worked that first 12 months, and I'm not doing anything differently. And it was just the cold reality slammed me right in the face and took all those profits away. Maybe even a little bit more that first year, or my first losing year after my first winning year. But yeah, that was the cold truth hurt at that point. It finally caught up to me. Okay, now I understand why everyone says this is so hard, damn near impossible, and over 90% of the people fail doing this.
All right, so let's just bring listeners up to speed and put things into perspective here. So from what I understand, it was the next 8 years that followed from there where you pretty much had losing year after losing year after losing year. Is that right?
That's right. Yeah, 7 years to be exact. And it was for those 7 years, at the end of every year, I was in the red.
Okay. So,
and again, it's just, yeah, go ahead.
Yeah, so I really want to dive into this because I think there's a lot of value in really kind of dissecting this and finding out why it took you so long, how you managed to break through and all that sort of good stuff. So, probably one of the first questions I'd like to ask you around this, 7 years losing year after year, it's got to be painful. How were you able to sustain these losses, and what sort of things did you do to manage your risk during this time?
Okay, so great questions, because after my second year of trading, I had my first year winning, second year I lost everything I won the first year. And at that point, I realized, okay, it's easy to lose, or it felt better to lose money that I'd made from trading in the markets, but it really hurt to lose money that I worked hourly for, that I worked on the side, I had a real, I worked legitimate, I don't want to say legitimate for, but, I worked as my job, my work, my business. A lot harder to lose that kind of money than it was to lose profits I'd already made in the market. So once I started losing, job money, my work money, that was that's when the emotions that's when it just felt terrible. It just felt so hard because I'd lose it so fast, and it would take me, so long, so many hours, X amount of hours I'd have to work to like make up for those losses in the market. And so that's when I started understanding, and I just went, whoa, okay, I don't know what I'm doing. This was very misleading for me to have a successful first year, and I clearly did not do well the second year. And I think I'm starting to know that I don't know I don't know anything really. I thought I knew all this stuff my first year. I don't. And that's when I put my size in check. And that's when I said, okay, since I don't know, and I've got a lot to learn, I am going to dramatically size down. And I basically went to just trading very small. I don't think over, I say on average, maybe $5,000 positions. And, sometimes I might get up to close to 10, but I just kept it in check. I never ballooned up because I didn't want to do more damage than I could recover from. But that was tremendous for me because, and it's not to say I didn't have, spurts of profitability in those 7 years. It's just that I'd hit periods of profitability and I'd do well for some amount of time, but it was just inevitable that it just dried up and the drawdowns would return, and I just would continue to just lose back on the drawdown. I'm back to losing money and got to wait for something to change, or got to change what I'm doing. I try and change what I was doing, and I tried all kinds of things, and some of that just led me off into worse directions, I think. But a lot of it was just, I think, having poor habits for a large number of years. And also because I own my own business, I wasn't starving. So I didn't really have like dire motivation. So I was making a good living working for myself. So I had income. So even though I might have been in the red for 7 years, hey, I'll add a little bit more money each year, every 6 months to refund and make my accounts healthy again. And, hope for the best. I mean, that's basically what it was.
Okay. So you said you had like some spurts of profitability. Do you recall maybe what was your greatest winning streak? Like, were you profitable for, say, 3 months in a row or anything like that? Or
yeah, maybe nothing that good. Maybe more like I was, I'd hit maybe 3 weeks where I do really well, and then it was always 3 steps forward and 5 steps back. Anytime I hit some X steps forward, I was taking more than X steps backwards. It was just a matter of time in those 7 years. It was just really hard.
Okay. And how frequently were you trading during this period, just sort of on average? Were you trading, 5 day trades each day, or was it something, a couple trades a week?
So a couple years into it, I don't really know, but at some point, maybe if I was to guess, I'd say maybe 3 years into it, maybe a little less, 2.5 years. I don't know, somewhere around there. I kept funding my accounts, and I probably had one account at that time, and I got over 25,000. So I was getting a taste of day trader's margin and the ability to fly in and out as frequently as I wanted to, with as much as I wanted to, and not being shackled by the pattern day trader rule. So that was really good. But in hindsight, even though I had over 25,000 in the account, I almost wish like I didn't, because I probably would have saved a lot of time and money had I been under the pattern day trader rule. Probably would have been more of a service to me than a disservice. I think a lot of people see it as a disservice, and it is. But I mean, the reason it exists is to, quote, protect people, at least the people that were as degenerate gambling habits like I did. I think that's why the pattern day trader rule to protect us from losing all our money so quickly, at least.
So how were you affected by the pattern day trader rule when your account was under 25 grand in the beginning?
Yeah. So when I break under 25,000, it was like, okay, now I'm shackled, right? I'm shackled by the pattern day trader rule. So then I would just do my best to either trade my way back above it. Even if I did, I was always nervous because I was so damn close to it. Or I'd go, all right, I'll just throw in another $5,000 and boost me up above it, so I don't have to keep being so paranoid about it that I'm going to break it and get below it again and lose all my freedoms of flying in and out of stuff as I please.
Yeah. Okay, so it was kind of like that $25,000 point was like a psychological level for you in some ways.
Oh man, I think I still have nightmares about it, even though it's not really a problem for me anymore. It's just an old nightmare that won't leave me alone.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So what did your partner and your friends think about your trading efforts during this time? Like, I presume it probably came up in conversation as you're talking about your friends. Your friends might ask you, how you going with, how's your trading going? You've been at it for a while now, and, you can't really say like, oh, I'm making much progress. What did they kind of make of it? What did your partner think of it? I'm keen to hear.
So I wasn't too... I was doing really well with my business on the side, well enough that I could fund my accounts. And because I kept my size in check when I was trading, it was just a slow bleed over time. And even though I was bleeding out for 7 years, it's not like I was taking, 20% hits of an account on a single trade or anything, So I was always around, I was always just trying to figure it out. I had deep aspirations. I had passion for the markets. I knew one day, I hoped one day, I'd figure it out, and I would rise and stand up, and banish all these losses I've had and figure out what I was missing and find that holy grail, that I've been looking for, and just always consider myself an intelligent person, and I love solving problems and puzzles and whatnot, and I've just always been mesmerized by the stock market and just drawn to it since I was ever exposed to it. And I just always thought I could figure it out. So when friends, girlfriends and whatnot at the time, and friends of mine would ask me, hey, how's it going? Man, I just tell them, this shit's tough. It's like the problem was I told them all my first year how great I was, and I was so proud of myself for my success for my first year. When they kept asking me later on, hey, how are things now? And I was going, well, I'm getting a reality check. I'm basically getting my ass handed to me, and good thing I'm keeping my size small, because if I wasn't, I think I would have blown up by now, because that was definitely the course I was on. And seriously, the only thing that kept me going as long as I did was minimizing my size, just knowing I didn't know. When people ask me, I always feel good. Being happy is a habit. I try not to let the money affect me, but it's hard losing money for 7 years on something you're so passionate about. So when someone tells you that's close to you, hey, how's it going? How are things? I'd love to tell them, hey, things are great, but instead I just smile on my face that this is hard, and I'm determined to figure it out. But as the years went on, yeah, I definitely started doubting myself. Maybe this isn't for me or whatever, but I pulled through. I was just honest with people when they asked. I don't think anyone was worried I was going to lose all my money. Not that I had a ton of money, but I think everyone believed in me around me, and that helped me keep doing what I was doing too, even if I was losing money.
So speak to us about that doubt. You know what I mean? Because I think there's a lot of us who do experience some doubt, especially when we've been sort of chipping away at this for a few years, and it feels like sometimes we're just spinning our wheels. We're not making a great deal of progress. How did you overcome or push through those doubts? Like, what kind of kept you going?
I think I had hope from the periods of profitability I would encounter. I just, something inside me said there's got to be more to that than luck. And I just got to figure it out. Like, there's got to be more than just luck to that. And I mean, if it was just luck, then fine. You know, why am I even doing this? Because I'm proving that if it was luck alone, I'm losing money more than I'm making money. So, but I think that's what, even though I'd encounter those doubts, that's what held me together. It was my, determination, perseverance, if you will. But I was just convinced it had to be more than luck. Poker is a game of skill and luck. It's got both factors, and I definitely today think that now more than ever about the stock market. But back then, I was just hoping it was more than luck. And the glimpse of that was those periods of profitability I would hit. And when I'd hit them, I'd love them, and it'd feel great. It was just unfortunate that my poor habits would basically, I attribute to the inevitable drawdowns returning.
Yeah. So what do you think were the aspects of trading that you found most challenging to come to grips with?
Just, man, it seemed like no matter what, like, it was really hard for me to understand. I'd learn patterns. I love patterns and whatnot, but I'd learn a pattern and I'd see it work. Obviously nothing's going to work 100% of the time, but to see a pattern that looked like it would succeed, and it was the same, looks like a similar setup the past 10 times I'd seen it succeed, and then to have it fail, that was really hard for me to accept because I wanted it to succeed, because I wanted me to succeed. And I think I was just pressing a lot of beliefs onto, a lot of hopes into what I was doing, instead of being more of an observer and more objective and taking a step back. I was much more forceful trying to make things work. And there's a lot of aspects about trading that are challenging, no doubt.
Yeah. So if I was to kind of summarize what you said there, it sounds as though you were trying to trade what you wanted to happen instead of trading what was actually happening. Like, you were trying to sort of push your beliefs onto the markets, and override what was actually going on. So let's cut to more recent times now. I think we're going back about 14 months or so now. And obviously, for anyone who's listening to this sometime in the future, we're recording this September 2015. So what was your turning point? What changed that you were able to go from a losing trader to a winning trader? What was significant about what was a significant change in how you approach things?
Okay, great question. First, I may have misheard you, but I think you said 2015.
God.
We're recording this. I just want to be clear. 2016. I might be wrong. I may have misheard you, but
you didn't mishear me. That's quite embarrassing. Yeah, that's.
No.
Maybe I wish it was 2015 still.
Embarrassing is losing money for 7 years straight and not doing anything different.
Sure.
To answer your question, what finally made me flip the switch? After about 8 years, I reached the end of I couldn't take it anymore. And I just had a serious sit down talk with myself. Might as well have been looking in a mirror. And I was just, hey man, I've been doing this for 8 years. I am sick and tired of adding money. I'm sick and tired of taking money I work for on the side, income I make, and depositing it, adding it to my trading accounts, and just slowly losing it over time. It's not sustainable. I need something. I need to prove to myself that, hey, yeah, it's great to be passionate about the stock market, but man, I need to see some serious results and prove to myself this isn't just some pipe dream that isn't ever going to happen, and that I am able to do this. And man, Aaron, I wish I would have done that years and years before I did, because that was the catalyst for all my major changes to lead me to become a consistently profitable trader. I mean, there's so many things. I'd say all of these are factors, but it's hard to say any one of them was. I mean, they're all to different degrees important, obviously, but it's hard for me to pinpoint the most important ones. But 2 years ago, I went full time, so I had a perfect environment for trading stocks. I had no competition from work, from anything. So I was in charge of my own schedule, so I could be there when the stock market's open. I'm trading stocks. I had my full attention. I didn't have any competing forces. That was major. So all those other 8 years, I was trading part-time, trading at work, trading when I shouldn't have been trading, and it hardly ever worked out well, unless I got lucky. But so going full-time 2 years ago was a big deal. Not only that, this is surprising though, but I've always been actually a really private person, and I've never really been on social media. I've never had a Facebook account. I still don't. I've never had a MySpace account. I've never had LinkedIn or Instagram or Snapchat, or I don't know, all the crazy kids and what they use today. I don't do any of that stuff. And so all those 8 years I was trading alone, and I was by myself, and I had basically no one to compare myself to. And that created an environment for me to just float around and go nowhere, or even a little south, because I lost money for so long. Once I discovered Twitter, oh my gosh, that just changed everything for me, because I got plugged in, man. I went from being passionate about the stock market and knowing no one and seeing what other traders were doing, to being passionate about the stock market and getting plugged in to to Twitter, where all the traders are, and I could see what everyone was doing. And that just made the world of a difference, because surrounding yourself with people that are better than you is huge. And since for those 8 years I've surrounded myself with no one, that's a factor of why I went nowhere. So once I discovered IU and Nate, and I learned about shorting. I mean, for those 8 years I traded, I was long only. I knew about shorting it later on, but I didn't even know you could short cheap stocks, low price per share stocks. I just kept going long, bad habits, I guess. Once I discovered IU, and hey, there's multi-millionaire traders in this chat room. Wow, let's see what that's about. So I got plugged in there, and I just started watching what other people were doing. Between IU and Twitter, man, that just really gave me the social connection to other traders where I could thrive, because I'm a competitive person myself, in a good way, and I think competition brings out the best in some people and the worst in others. But for me, I think it brings out the best in me, and I don't know why I went 8 years trying without any competition. But once I was able to surround great people around me, then I was able to start asking myself, hey, these guys are humans just like you. What are they? Why can't you do what they're doing? Not that I'm a multimillionaire trader, but they're consistently profitable. Why am I not consistently profitable? Like, it's not like I have worse luck than them. I mean, we're all getting the same luck in the market. Like, it's the skills. Like, what are they doing that I'm not doing? Or what are they not doing that I am doing? And that was a big factor also.
Okay, so I mean, there were a few things which had a big impact on on your own trading. So, they were your working environment. You went full time into this, so you weren't competing with your day-to-day job. You kind of reached a snapping point and you had a big mind shift and getting plugged in with other traders, like meeting others who were doing what you wanted to be doing and were better at it. So, no, that's really cool. Now, I do want to ask you, how did you prepare to go full-time trading? Did you have a significant amount of savings? Did you cut down on how much work you were actually doing, or did you just straight up close the doors one day? How did you actually prepare to go full-time trading?
So I actually still own my business. I just am not trying to grow it like I used to try and grow it. It is big enough that I am comfortable and I can choose my own schedule, and I decided I no longer want to work on site. I want to work from home, and so I just do my own thing at home on my own hours, and that gives me the ability to trade as I please. And that was a big deal. So yeah, I do have savings. I do. It's that definitely helped also making the switch. But just being in charge of my own thing. I mean, that's really it's tough to beat that kind of freedom, and I feel very fortunate to have it. I really do.
Let's move on a little bit. Let's talk about how you're actually trading today. Let's dig into your actual methodology. So, how are you trading today? What is your approach if you had to define it for us?
So I love shorting. I'd say I'm 90% a short seller, I think. I'd guess about 10% of my trades are longs, maybe less. And my ideal short is what they call flying pigs, junk microcap companies that are starving for cash, laden with debt, they're just terrible companies, and they're hurting, and they're forced to do dirty things to raise money. And when they do those dirty things, like put out fluffy PRs, and you get these stocks gapping up, 30, 50, 80, 100% or something silly, whatever it is, I'm highly interested. Those are great things. Good opportunities there.
So how do you find these junk stocks, as you call them?
I find them every morning by just looking at what's moving in the market and pre-market. What's gapping up? What volume breakouts do we have? What stocks are up today on more volume in pre-market than they've had for the average volume the past 20 days, month? Is their volume in pre-market up 400% from there? Well, I want to know about it. But it could be even much more simple than that. It could just be a high-a-day gainers list in pre-market. What's flying high? What's flying high this morning?
Okay, so you said a little bit just before your ideal short setup or your ideal short stock that you would short would have some sort of fluffy PR around it, or they've done something sketchy to try and raise the price of their stock. Looking at your pre-market gainers list and that sort of thing, that's obviously looking at the price. Do you also need some sort of story to support this?
Sure. So as I encounter what a lot of us call pigs, I have a pig list, which is just a watch list I've titled pigs. And I recommend anyone that's interested in shorting pigs do this if they're not already doing it. But it's a very simple idea. Probably a lot of people are already doing it. I don't think I invented it. When I encounter a pig, I add it to the list. And over time, my pig list grows. Right now, I think I have maybe a little more than 200 pigs in my list. And this makes when they run in the future, former runners. So as they tend to pop up, a lot of traders know how they traded in the past. I always have my pig list up, sorted by net percent change on the day. And as something starts flying, if it's a pig, if it's on my pig list, I already know I'm interested in shorting it. I don't have any homework to do. I don't need to go looking at the SEC filings to see what's going on. Although, I might look up at the headline to see, okay, well, why is it moving? Why is it? I definitely want to know why it's moving today. Is it up? Is it up on nothing? Is it just up because traders are just buying it up? It's just chasing it up because it's low float, or is there some kind of fluffy PR? Is there some kind of, or is there an SEC filing? What's the reason it's up, and try and understand why it's up. But as long as it's on the pig list, I know I'm interested in shorting it. Once they start moving again, it's just a question of when and at what price.
Okay, well, that's the next question I want to ask you is when do you actually go short? So obviously you're identifying these stocks pre-market, which are significantly above the close of the prior day. At what point are you looking for a short opportunity to actually enter?
Yeah, so, ideally, I'd probably be waiting for the backside, for it to go as high as it's going, and then for it to, if it's going to fade off, or if it's going to snap VWAP or crack or whatever it's doing, high a day rejection, stuff off the high, whatever it is, and then just get in there, because that's typically much safer water to jump into for the short seller. But it's not to say I don't like a thrill, although that might be ideal. I tend to start shorting on the front side, which is definitely a lot harder than shorting the backside of the move. You're basically stepping in front of a train, and you don't just wish for the best, but you try and identify where you think it might top, or at least that's what I'm doing. And I'm just trying to read the chart, the volume, see how it's responding to VWAP, and make an educated guess.
Okay, so like you said, it could, some people might interpret this as standing in front of a train.
Oh, definitely. Momentum is dangerous if you're a short seller.
So how do you manage your risk in that case? Because I imagine, if you time this wrong, you could be very wrong very quickly. How do you go about managing your risk?
So part of it kind of goes back to that similar answer from how did I lose money for 7 years straight and just was still alive to keep being in the stock market. And for me, it's controlling my size. I'm not a gunslinging cowboy. I don't size up. I'm not throwing size around like a lot of other traders do. And I'm not saying that's bad that they do that. It's just, for me, I still have a lot to learn about trading, and I'm always going to be learning about trading, but I still have a lot to learn in the sense that although I've learned incredible amounts more than I used to, enough that I feel comfortable, I can step in front of on the short side or on front side and get short. I'm keeping my size controlled so that if something rips against me and goes, just ridiculous, parabolic or something, I'm not sitting in there with my entire account sweating bullets now, because I'm definitely not trying to put myself in very, very bad situations like I used to do, and I'm much more aware of that. So yeah, controlling size is definitely my answer. So scaling helps. If you're a one bullet shooter, it's kind of hard for the guys that are under the pattern day trader rule, because they can't scale because they got one shot, or two shots or whatever, however many bullets they got, and that's about it for their, for a few days until they get their bullets back to take some trades. But scaling and controlling size is how I stay safe.
Okay, and on any given trade or short opportunity that you've identified, how many times are you willing to be wrong before you let it go and just move on? Like if you get in and, let's say you have a stop higher up that gets hit, taken out, you're out of the market, do you attempt to go short again X number of times before you just leave that alone?
Yeah, I used to not do that. I'd try it once, maybe twice, and then if I hit, if I if it got to my risk level, I just took my loss. And then it seemed like inevitably it would finally do what I wanted it to. And I was just watching it, not participating. And I'd go, man, should have taken it again. But some stocks are very, very, very difficult. I'm sure a lot of traders have the same thoughts. You know, you have an idea on it and you take it and it didn't work, you take your loss. And then you could try that. In some of these stocks, I swear they're doing it just to mess with you. And you might try it, 4, 8, 12, 15, 15 times, and you're just exhausted taking small losses on it. But, then you get easier ones that they just crack and you just get in there and you just hold on for the fade and you get paid. There's all kinds of different animals in these charts, and there's so many different types of plays too. It's just a lot of patterns and a lot of opportunities to make use of.
Okay, so just slightly changing the subject, looking at your Twitter feed, it's clear to see you're massive on documenting your trades. I don't know if you've always been this way, but what exactly do you do? Like, what do you go through and how do you document your trades?
Sure. So when I finally reached the end of my rope and was like, I need to see some results in my trading because I've just been losing money for so long. Part of that was I realized that, you can't improve what you don't measure. And I think some people will argue, well, your account balance is what is the metric. That's how you measure. But for me, I needed something more than that. And I started tracking my P&L. And to not be that degenerate gambler who's just pulling the handle on the slot machine time after time after time again, even though it stops work, even though it's not working, I wanted to start tracking my journey and see what I could learn from it. And it seemed to me from some of the books I read that, tracking your equity or your P&L curve is a good metric of how you're performing. So I thought, wow, that's interesting. I haven't done that for 8 years. Maybe I should start now. I'm trying to make big changes to make this trading thing work. I should start doing that. So I got a Twitter account and I said, all right, man, everything, whatever I trade today, I'm going to put it on Twitter for the world to see. And it's not really so much for those people, for everyone to see. It was for me. It was for my own benefit to help me stop being a degenerate gambler in that sense, and to be more responsible and to hold myself accountable for my trading decisions each and every day. And that helped me get a handle on my over trading. That helped me get a handle on my being impatient. That helped me get a handle on becoming consistent. It helped. There's a lot of people that don't believe in posting P&L. I'm pretty certain I'm outvoted. A lot of people don't think it's a good thing for the trader to do that. Me personally, I so firmly believe, for me, that it was a factor, and I even think to say a large factor, in helping me go from being a losing trader to a consistently profitable trader. Because the amount of accountability and feeling of responsibility that it provided me, thinking that all these other traders were looking over my shoulder. Not that they were, not that I had all these followers or anything. I mean, I didn't have any followers when I first started doing it. But again, I was doing it for me, not for other people. It changed something in my head. And I started making much better decisions when that was definitely a factor to me making much, much better trading decisions. Kept me from being reckless, because I was very easy to be reckless for a lot of years. I could go from zero to reckless extremely quickly. And I don't do that anymore at all. I try not to.
Yeah, I like what you're saying there, because when you do post your P&L, and when you are not so much that, when you do have that accountability, I mean, it's very easy to lie to yourself. As much as you don't want to do it, it's very easy to do. But when you've actually got, like as you described it, there's someone looking over your shoulder, that accountability and actually having to lie to someone else is very difficult, or for most people anyway. But I just want to throw in there actually, measuring your P&L, I think, is probably quite effective when you're at least a profitable trader. When you're not a profitable trader, up until that point, it can be quite difficult to measure your success in terms of P&L. And Futures Trader 71, who was on episode 82, has a really good bit about how other ways to measure your success, or your progress, I should say, besides your P&L. So if anyone wants to hear more about that, chatwithtraders.com/82.
I think I want to hear more. I think I'll be listening to that one, because that sounds great.
Yeah, no, he's awesome. Definitely check out that episode with FT71. He's the man.
That's cool. Yeah, for me, when I could see that I was building a spreadsheet and putting my daily P&L in it, and it would change what my P&L curve was doing, I felt like I had something tangible. Like I felt for the first time ever, I was in the driver's seat, and I was going, okay, I can make good decisions so that I can end the day in the green, and my curve will go up. And I felt like I was drawing something slowly over time each day, and kind of felt like an artist. Like I was like, wow, this is really cool. I want a really nice line. And it helped me making my decisions when I was trading and going, before I took a trade, I go, you know what, is this really a good trade to take? Is this just a substandard trade I should be skipping? Is this really a trade that I want to affect my P&L curve? Because if it's not, I don't need to be trading it. I'll just wait for a better setup. And that was a big deal for me.
I really like how you framed that as in, is this a trade I want to be affecting my P&L or my equity curve? I think that's a really good way of looking at it. That's cool. So just to wrap this up here, what suggestions do you have for traders who are just starting out today? If there was just maybe one or two things you could share with them, you've already shared a ton of great insight, but just to wind things down, one or two things to take away, what would you suggest to them?
We just got done saying it, but you can't improve what you don't measure. And for me, that was creating a P&L curve and tracking my daily P&L, along with some other stats that I've included also. But the other trader you mentioned had some good ideas you said about for beginner traders or struggling traders for tracking and measuring, some kind of metrics that they're using. Whatever it is, take a scientific approach and measure what you're doing. Please, if you're not, I really think it can help you gain insight into what you're doing and why you're doing it. That was a big deal for me. Another thing is habits. I'm a firm believer in, good trading is synonymous with good habits. And when you have bad habits, I had bad habits for 8 years, and it was very hard for me to unlearn those habits and create better, good habits. And if you're just starting out, it's great because you can start out from not having bad habits and you can develop good habits from the get-go. But if you've been struggling a while, identify what you're struggling on. Are you over trading? Are you impatient? Are you just gambling? We all have the same problems. It's just identify what you're doing wrong, and what they often, it's very common to say a chain is as strong as its weakest link. Find your weakest link and focus on it. Pick on yourself. What can you do to become a stronger person and a stronger trader? And lastly, I traded in solid, by myself for 8 years. I'm a competitive person. If you are too, surround yourself with great traders. Surround yourself with traders that are similar to you or a little better and like-minded. I have trading buddies I trade with. TWB52, shout out to him. 4Trade, shout out to him. Those guys were like-minded people, and we trade the same things. And we, you know, if you're out there hunting, if you're just one wolf hunting for food, you're not going to eat like you are if you're out there hunting with more wolves or another wolf, or you have a team of wolves or a pack of wolves that are like-minded and are looking to feed on the same thing. So, you know, connect with other people, find people that are like you, and see what you guys can do. You know, it's the Boy Scout system. You know, I used to be a Boy Scout. I don't remember what it is, but have their back, you know, and they'll have your back, and try and keep each other out of trouble, and just do your best and always learn, man.
Good stuff. Good stuff. Nico, where is the best place listeners can go to find out more about you?
Right now, it would probably just be I guess my Twitter. So at inefficient MRKT, and that's my Twitter handle. I think I'm going to start a blog though, because over the past 14 months, I've had a tremendous amount of people ask me for my spreadsheet that I created, where I track my stats and my daily P&L and my P&L curve. And I think I'm actually going to be releasing it very, very shortly into the wild for everyone to use, because I know a lot of people use TraderView, I think it might be called. I think it's free. Anyways, I don't know much about it, but if there's a lot to be said for just whatever it is. If you're using TraderView, great. If you don't want to pay for a service like that, I got a spreadsheet you can use. If you like what I'm doing, you could modify the spreadsheet however you please. And you know, I'd love to I've gotten an extreme amount of support from a lot of people for what I've been doing for the past 14 months. And I just want to say thank you guys. And hey, if you're not consistently profitable, I'd love to help you as much as I can. Send me a message.
Very good. So at Inefficient MKT on Twitter. That's it, right?
I think it's MRKT.
MRKT. Okay. Mark it without the vowels.
There you go.
Cool. All right, man. Well, I'll put a link to that in the show notes, and probably if anyone wants to get that spreadsheet that you're going to be releasing very soon, probably the best thing to do is follow you on Twitter, because I'm sure you'll put the word out then when it's available, yeah?
Perfect. Absolutely.
Cool. Well, Nico, I just want to say thanks a lot for coming on the podcast, man. I appreciate it.
Aaron, thanks for having me. I'm honored. I appreciate it.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by The Pool. Did you every decade the market online brokers open the doors, mobile apps making seamless, and commission erased barriers. Now a new era has limited risk trading. Reach the profit target. Trading risk is stock traders with up to $200,000 and join the stock trading revolution today.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What is happening, team? Thank you so much for joining me. On this episode, I have our very first guest from China, Derek Wong. He is the Director of Systematic Trading and Options at a private fund in Shanghai. Initially, though, Derek got his start in the agricultural pits at the CBOT. Then following on from this, he's worked at various quant shops in Chicago, South Korea, and nowadays mainland China. After discussing Derek's backstory, we talk emerging markets, cultural differences of Chinese investors, convergent and divergent strategies, diversification, and some slightly unconventional ways of thinking about how you trade. Derek also has some awesome insight for traders who are discretionary and what traders should focus on once reaching profitability. I thought Derek was a really incredible guest, and I hope you get some value from listening to this episode. One last thing I do want to mention, and that is Derek has very kindly offered to answer any trading questions that you might have. So if you've got a question that you want to ask, just go to chatwithtraders.com/97, scroll to the bottom of the page and write in the comments area for a response from Derek. All right, that's all from me. Let's get into it. Derek, how's things? Good day for you?
Yeah, it's actually quite a good day. I can definitely say that. So today we hit our yearly target for the fund, actually. So it was quite nice.
That's very cool. Nice to hear. Congratulations.
Thank you.
How do you go about setting those yearly targets?
Actually, it's by our mandate and the CIO. So based on that, we look at what departments, what teams can contribute what, and then so we look to mix those teams together. So my team's target has been met, other teams may have not been. So we're kind of like siloed out, if that makes any sense.
Okay. So what does that mean sort of going forward for the rest of the year? Obviously, there's still, like another 2.5 months left?
You can consider it like we are in kind of take profit mode, if that makes any sense. So we've reduced our leverage, we've reduced our volatility, and we're trying to hover around this area for the remainder of the year.
Okay, so you're not like trying to push harder and really take it as far as you can. You're sort of being a little bit more conservative.
Right, because how our products work is we do have some guaranteed products that we need to make sure that we can deliver on that annualized return, and then we also do just a profit split. So I need to make sure that I can cover those costs and give that guaranteed returns to investors, as well as, have the other party who's doing profit split be satisfied as well. So right now we're kind of in that happy medium. I would like to kind of cruise out, basically window dress for the rest of the year.
Okay, cool. Well, like I said, man, that's really good news. So congratulations. And I'm really excited to have you on the podcast because you're actually my first guest from China. But if I understand correctly, you haven't always lived in China. Is that right?
That is right. So before I'm born in Chicago, and I started my trading career in Chicago in the pits at the Chicago Board of Trade. And I always had an Asian leaning. So as I worked through different funds, and then I leaned over to South Korea, did a little bit of work there, and then eventually made my way to mainland China.
Yeah. And we're going to get right into that. But I mean, first of all, how did you actually become involved with trading? Because I know you were originally studying to be an engineer. So, how did this all sort of play out?
It's actually an interesting story, or well, rather, I was picking up the scraps. So my brother was offered a job to work for a friend of his father down at the Board of Trade, and he didn't want the job. So I ended up taking that job, and I said, hey, you're not going to do it, I'm going to do it. And that was it. I took the job, I interviewed, and, however that's going to be, and I just started, clerking and running down in the pits as electronic really started to make that transition in the early 2000s.
Okay. So what was your job specifically like as a clerk? Like what sort of things did that involve? What were you doing like each day when you showed up?
Okay, so each day, we were basically filling institutional order flow, and we had a couple of traders as well. So what we would do is we would look at what our clients wanted to trade in corn. That was our major pit, soybeans as well, rough rice, and the ags. So we would look at, the previous day's activities, what orders were sitting in our book, what we looked look like to fill. And, we looked at seasonality. We were looking at, what kind of volumes we're expecting and how we were going to get that out there. And then basically just, filling, fairly large orders for these people, for these institutions and commercials for hedging or, trading purposes. And so we had one guy who had a big Palm Pilot, I guess you could think of it like that, or a big iPad type thing who could do electronic. And we had a couple of people in each pit that would fill by hand. So we had a mix of electronic and we'll say pit traders, and we could work the orders either side to fill their orders coming in over the phone.
Right. So if I understand this correctly, you were filling large institutional orders. So pretty much they would say, we want to buy X amount of whatever that might be, and then it was up to you to try and get them the best price on that order. Is that correct?
That is correct.
Okay. So how did they measure that? How did they sort of gauge whether you were successful in getting them the best price or otherwise?
Well, they would measure us by how the market had moved. I mean, back then it was still pretty slow. Not a lot of people had as good of tick data as we have now. So we're looking at average prices during the day, the settlement price, because it might take us a couple of days to work the order, or they might have certain conditions that needed to be met. So those were different benchmarks. Every company would give different criteria that they were looking to have executed against. And so we would look at that and say, okay, how can we best, suit their needs of the client?
Okay. So how long were you working at the Chicago Board of Trade for?
For 2 years.
Right. And then what happened from that point? Like, where did you go from there, and why did you decide to leave?
Right. So then that was still when I was quite young in university. So after that, I ended up going into the family business a little bit, and then transferred back into trading. So kind of a roundabout way. I'm the oldest son. So in a Chinese family, it is my duty to kind of take hold of the helm of the family business. And I tried to do that, but it really wasn't my thing. So I ended up using those previous connections I had built from the floor. And actually, I went to school with quite a lot of traders. My friends' parents, I didn't realize it until after that they were a lot of traders, a lot of people at the Board of Trade, Board of Options, stuff like that. And so I kind of used that to lean into it. And that allowed me to use my engineering experience to start to do programming and analytics on the more quant side. So I joined a small fund who had systematic trading strategies. And so that's how I got into the quant side, because using that engineering background. Does that make sense?
Yeah, no, it does. So, I mean, I'm just curious, what was the family business?
Oh, we were import-export and in beef. And so it's still physical commodities, but the actual cash business. So we did have a seat on the exchange that would do the hedging. So I moved back to the physical side of things. So it was same value chain for a producer, but I was the producer instead of the trader.
Okay, I'm with you. So tell us a bit about the quant fund that you moved into. What type of strategies were they trading there, and what was your role more specifically?
Okay, so my role there was junior quant strategist, I guess would be the way to put it. They were a multi-strategy fund run by an ex-Merrill Lynch guy. He had previously worked in Japan, launching a desk there, and came back to the States and was doing a stateside fund. And so what we were doing was we had some PhDs, and we had 300 trading strategies, and it was just a multi-strategy, and we were trying to see how we could fit that together to trade the US and then still keep leaning towards Asia, which is how it evolved into going into South Korea.
That's crazy. 300 strategies. Is that normal?
This is where I really learned how to manage, analyze individual strategies and then manage them into a single portfolio. And so really that kind of developed into my philosophy that really got baked into me really early, thinking about more than an individual strategy, more than just how any one strategy works with another strategy, but thinking a very like 30,000 foot view of how to think about running a fund based on strategies, right?
Yeah, and I mean, that's something I really want to pick your brain about as we get a little bit deeper into this, because I know that's something you're very big on, is the multi-strategy approach. Going into this quant fund, did your engineering background help you? Like, to what extent was that beneficial?
Okay, so actually one of my final projects, this was almost like 10 years ago, more than 10 years ago, was doing self-driving cars, the logic for self-driving cars. So what we were doing was we were scanning the roads and taking input from, the white lines on the road to make sure a car could stay inside those lines and predict collisions. So by having that understanding of logic and, seeing, okay, if this situation, what happens, and programmatically working out a lot of different edge cases, that allowed me to transfer over quite well to the trading side of things, because I understood, this thing is going to be automated. It's already running by itself. How do you make that run, as well by itself that it can do? And if some unexpected situation comes up, like an unexpected collision, how is it going to react in those cases? So when I went to the trading side, it's the same thing. So you have a system, right? It's going to automatically trade by itself. When an edge case or high risk or high volatility point comes up, how is the system going to react? How is your automated car going to react? And I think that it was quite a very easy leap for me to go there and still to apply a scientific process and engineering problem-solving mentality to the problem.
Okay. And going into the quant fund, like previously you were trading you were a clerk on the Chicago Board of Trade, on the floor. Did it require much of a mind shift from doing things that way to actually working in a quant fund that was sort of juggling 300 strategies?
It was a bit of a shift, but a lot of people in Chicago come from the floor. So a lot of people made that transition and then went upstairs. So a lot of the analogies that I had are that basis of understanding. They could communicate it to me. I think it's a much different environment, say, in London, or some other place that might not have as a strong pit structure. So those guys, I think it would have been a much more difficult transition. But because I was surrounded by guys, or, the upper management was or had the pit experience, they can make a lot of analogies. So it was really transcribing down what their strategies were or what they had felt worked over the years, and then adding this level of engineering on top of that, or statistics and mathematics built around what they already knew worked. So they already had several strategies they had been trading for 10, 20 years. They wanted to make that programmatic and then use engineering and mathematical principles to verify or validate those strategies.
Okay, yeah, sure, that makes sense. And, your role there as a junior quant strategist, what sort of things did that entail?
Honestly, it's just a glorified intern. Okay. I just watched a lot of the other guys, what their ideas were, watching their process, debugging code, because I had already knew how to code in C++, so having a coding was definitely important. I also could understand the formulas, the mathematical formulas that they were using, and so just being a sponge, man. I just learned as much as I could and figure out why were these things working? What was the analogy between the pit or the market and what this trading strategy is trying to accomplish? And why is this phenomenon they're targeting something that we believe is profitable?
Mm-hmm. Okay. So, I'm not sure how long you stayed there for, but what brought you over to South Korea and China? Walk us through that stage.
Right. So, like I said, a lot of these guys, well, actually the boss, he was in Japan first. So a lot of emerging markets and I'm Chinese American and he was Japanese American, and the original guy I was working for on the floor was Korean American, so we had a lot of Asian influence there. And there is a big difference between emerging markets and, we'll say, mature markets. But for trading strategies, automatic or algorithmic trading strategies, you require a certain level of infrastructure to be in place. So earlier, say early 90s, late 80s, Japan was that type of market. They had the technology infrastructure. They had that type of thing. You could go do that. Then South Korea came online. They had electronic markets. They had futures. They had options. And then China is the next progressive step, because in emerging markets, there is a higher signal-to-noise ratio and a higher usually propensity for, we'll say, retail traders, less institutional, less HFT, less well-established players that have high amounts of infrastructure. So you can reduce your competition and increase your profitability by being able to navigate inside of those markets with strategies and technology and process that you have already developed, say, in the States. So I saw them do that progression, and so coming to China for me was just a continuation of that type of thinking. And I have done some quantitative research on this that you can look at price series and see that there's a lot more dispersion in, say, China versus the US. And in China, the stock market is, I'm going to say rough guess here, 80% retail, 20% institutional, while, say, in the States, it's the absolute reverse. So if you can imagine walking into a market that's like that, you can understand why it's such a tempting offer.
Yeah, okay. So, I mean, that's a really interesting answer, and there's just a few things I'd like to ask you around that. So, I mean, first of all, would you mind just explaining and just really clarifying, what do you mean by emerging markets? Like, what defines an emerging market?
So I guess I'm not using a traditional economist's view of an emerging market. I want to say financially developing and we'll say, securitization of certain financial products. So there is becoming to be so China is interesting because its economy is the second largest in the world. But their financial system has not caught up to, say, be the second most developed financial system in the stock market, in the futures market, in the options market that is equivalent to that, right? So you can look at many other countries that have a smaller economy but have a much stronger financial system. So it's not the economy part I'm looking at, it's at the financial system part. And so for say, the development of new futures or new exchanges or stock markets, things like that, that's the kind of development I would like to see. So another example of this would probably be India, would be another great example of this type of emerging financial market. They have been a very strong emerging economy for, over a decade. But I would say that their financial market and securitization of financial products has come to light probably in the last 3 years, where it's quite good to trade, where they have developed enough infrastructure, where you have developed enough liquidity, where there is enough institutions in the market and enough trading in the market to make it worthwhile to trade and not completely bonkers, but not so much so where it's become like the US or Europe, where everything is, highly efficient, high amounts of HFT, high amounts of, say, quant funds or, investment banks or things of that nature.
Okay. And you brought up a point about signal to noise ratio. What does that refer to?
Okay. So from, we'll say, engineering standpoint, we're on this call, right? So there is some noise in the background on this Skype call, but how much of the sound that is coming through your system is my voice, and how much of that is white noise or lag from the internet or other types of latency or, resistance coming from the wires of our, different setups. The greater the signal is, the clearer you will hear my voice. So any strategy is also trying to capture a signal, whether that's, we'll say, trend following, so or a mean reversion or a carry trade or whatever. There's some signal you're looking to capture. How strong is that signal versus the background noise of what's going on in the market, and how easy are you able to discern one from the other?
Right. That's a really good analogy. I like how you did that. Very good. Now, the 80% retail versus compared to 20% institutional in China, why is it that way? I mean, do most funds in China trade US markets? Like, why is the ratio split like that?
Well, no, they do not trade outside markets because of the RMB exchange. So they have a certain quota that every Chinese national can do per year, which is not very large. And they don't have floating exchange rates. So that does put a crimp on how much they can trade abroad. So they're limited only to the domestic markets. Also, hedge funds, investment banks, a lot of that stuff is quite new. So it's not. Also, a lot of it is fraud or shadow banking, or there's a lot of guaranteed products that it's going to get you, 12% a year or something like that on leveraged properties or some crazy, insane products. So a lot of people are savers. They save the money and they manage it themselves. And so they're going to go out and buy houses. They're going to invest it in the stock market. They're going to invest it anywhere they can get a return, but they're not putting it in an institution like we would in the States with a 401k, or put it into like a Vanguard ETF or, SPY or something like that. They're out there investing in stocks themselves. And there's a huge population doing that. So that really causes that percentage ratio.
Okay, so probably a good portion, 80% of the retail, a lot of them are mainly investors and not necessarily active traders. Would that be a fair assumption?
Oh, no, they are active traders. They are 10 times more active than any American. Their average trade might be less than a week. Their holding period, 3 months, is long term. If you told someone you held a 3-month trade in China, they're like, "Wow, you must have made 100% on it or something." Like, that's not the type of thinking. It's just a totally different type of thinking and culture and background of the retail and the institutional here in China. I mean, it's quite a different perspective on things.
That's so crazy. So, you know that common thing that you hear floating about is 90% of traders fail. How does that sit in China? Like, do most people, like this 80% we were talking about here, do most of them do fairly well?
Okay, so in a bull market, everything is easy. China has been in quite the bull market for a very long time, so people are used to making money. After the stock market crash, I would say significant people took a hit. So I just talked to a coworker of mine last week talking about this. We trade mostly futures, so I can give you a better perspective on that. We were discussing the differences between, traders, both non-professional and professional traders abroad versus here. And he said in China, it's 95% of people fail for the retail area. So actually, it's a higher percentage of people are failing here because a lot of them trade rumors. A lot of them have, listened to gurus on TV. There are guys drawing charts and technical analysis, telling your grandma how to take a trade in her retirement account. I mean, it's wacky, man. I don't know. I cannot. If you have never seen it, it's hard for me to explain what it's like, but it's definitely a lot of retirees probably got very much hurt in the last year.
Yeah, it's funny you mentioned that actually, because I remember reading an article a little while ago now about, I'm pretty sure it was in China, and there was like a soap opera on TV, and they mentioned a company, and that company did something which would be interpreted as being good news. And this was only in the soap opera, like it was all made up. It was just acting. And that company's stock like soared over the next like week after that episode came out or something like that. Like, is that the sort of thing that happens on a regular basis?
Absolutely. The virality of news in China is extremely fast. So we have WeChat. For people who don't know, it's like WhatsApp, but for mainland China. And there are tons of investment groups, private ones, public ones, whatever. Someone makes a recommendation who's got, a high rating. You'll see thousands of people, buy into that. Definitely you'll have a volatility spike. Definitely you'll see the market move in a particular stock. I mean, it's no question that anything they see on TV, reality or not. I mean, if they pay these stars to wear, some clothes or some hat, if it becomes fashionable, automatically in the next 2 weeks, everyone's going to have one. I mean, just how things spread like wildfire in China, just because of the interconnectedness, I think does, play into that. And that definitely, when you think about retailers doing this, it definitely hits their psychology. I mean, if you imagine how retailers think, and you imagine how some of these people don't have a trading or financial background, and they're out there trading their own money, they're going to be hitting with these swings. So you compound the huge amount of connectedness with trading psychology, and you can imagine why the types of moves you see in the Chinese market exist.
Yeah, it's fascinating, isn't it?
Yeah.
Let's bring this forward to current times now. Bring us up to speed with what you're doing today.
All right. So today I'm working at a fund called Trade Investment Management Co. Limited, and we are a investment arm of a Shanghai-listed company. And for us, we are a private fund, and I am the director of systematic and options trading. So what I do on a daily basis is just trade a portfolio of algorithms that fit, like I said earlier today, our mandate and our target, and use a variety of systems and control my portfolio in such a way to generate a product that will satisfy those investors' needs.
Okay, so you mentioned earlier that you trade futures, and you've just mentioned that you trade options as well. Are they the two products that you trade, or do you also trade anything else?
No, that's all we trade. And actually in China, there's only one options contract that exists. So, and it's highly regulated. You can only have 10 contracts on. So we are preparing for that. But like I said, developing market, there are no options on commodity futures yet. It just does not exist. That is an innovation that will come out in the future. So preparing for that is what my department is, and that's my official title. But just imagine that there is none.
So the options that are available, what are they? What's the underlying asset?
It's on the stock market index.
Right. So how do you use those options? Like, what purpose do they serve in your portfolio?
I'll be totally honest with you. We don't trade them. It's just in my official title.
Got it. Okay.
So when it comes out, I can trade it, right? But until then.
Right. At least it's in your title. So when is that expected to take place? Like, is that happening sometime soon?
That's a fantastic question, because we have been waiting for it for quite a long time, and it's all up to the government regulation. Everyone tells me it's coming soon or next year. But until the CSRC, which is the equivalent of the Chinese SEC, approves that and the party approves that, there's no telling. I was actually down, I want to say about a month ago, a little bit more than a month ago, talking to the chairman of the Zhongzhou exchange and other exchange officials in Dalian to try to find out what the target is for this. And, it was still up in the air. Everyone is very excited, saying it's going to come through, but there was no verifiable date for that.
Okay. Well, I bet you're hanging out for it.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Let's get stuck into the strategies part. Talk to me about what are the type of strategies that you're trading at the fund. What are your algorithms doing?
Okay, so I like to think of trading strategies in two families, divergent and convergent trading. Most people associate these two types with trend following and mean reversion, but I don't think that that's such a great definition. So I would prefer to use divergent and convergent. Majority of our strategies are divergent strategies because, as we know, China is highly volatile. It does have a lot of, big moves, so we do look to capture that, and then backing that up with some diversification in the convergent strategies.
Okay, so would you like to flesh that out a little bit more? Like, why do you refer to these strategies as convergent and divergent rather than trend following and mean reversion? Like, are they different in some way, or do you just prefer those titles?
No, I think the definition is much better. So let me see how I can put this in a very crystallized manner. So let's start with convergent. In convergent, we believe in something, and normally that something should occur. So in mean reversion, we believe that there is some mean or some true value, and when price is away from that, it should return. So we believe in this mean or that true value as a state or a price that we can hold. And when things are away from that, we believe it should approach to that. Another good example of convergent trading is value investing. You believe that the fundamental pricing of a company is X, and if the share price is not representative of that fundamental value, then we should buy it until it approaches that fundamental value. So that is something we believe in fundamentally, right? And this is something we have researched or we have found, and we expect the state of the market to maintain that relationship. Does that make sense?
It does, yeah. So when you're talking about convergent and divergent strategies, the trend really has quite little to do with that, right?
Right. So a trend, we believe it's not going to be normal. The state of the market is not going to fit into our criteria. There's going to be some radical shift, right, that's going to happen. So we can imagine a trend as a radical shift away from where price was before, right? So that means that whatever that quote unquote fundamental idea that it was in convergent trading is no longer viable in the divergent trading, right? Because, the price has moved so far away from that. So that is where we come to the difference. Another, I guess, characteristic of these two would be the distribution of the returns for both of these strategies. I think that's a much more important thing to look at because they have opposite return distributions, and usually you'll be able to classify what type of strategy that is by looking at that, or even look at a hedge fund or a manager's or a trader's return distribution and figure out which one of these two he's leaning towards.
Okay, would you mind just dumbing that down for us a little bit about the return distribution between the two?
Okay, so if I add up all the percent returns or the log returns I generate every day, and I put that into a histogram on my Excel, it will draw me a picture, right? And so we'll say that there is a line where my average is. So we put it on the Excel and we get the histogram. If we have the tail on the right side, okay, we have most of our losses on the left side. So that means we'll have a big fat lump where we're losing more frequently, and we have a big right tail, which means our profits will be much larger than our average losses, which is a characteristic of a trend following. So that'd be a divergent. On the other side, if we had a convergent strategy, our, big hump would be on the right side of zero, right? So we'd get a lot of winners a lot of the time. So we'd have a very high win rate, but our tail would be to the left, and that means we would have a lot of infrequent but large losses. Does that make sense?
Yeah, no, that does make sense. So, I mean, I guess my next question would be, how are your algorithms programmed, or how strategy set up to detect when to trade a convergent or a divergent strategy?
That's a good question. So, first of all, we need to think top level. And for the most part, when you make a fund, you're making a product. And each one of these strategies is an ingredient. Each individual strategy is an ingredient. We need to mix those together somehow, right? That mixing together, we use something called dynamic portfolio. And what this does is allows us to look at families of strategies, right? So you might have some calendar carry trades. You might have, we'll just say, breakout trades or momentum trades, or you might have, statistical arbitrage, or you'll have all these different families of systems out there, all with these different parameters. And we need to, be the chef and combine these together in such a way that makes sense for our end goal, right? So how we do that is we go through the three-dimensional diversification model that I have developed.
Okay, so would you mind explaining that model maybe a little bit more?
Right. So we know that diversification is really important. Everyone knows it's the only free lunch on Wall Street, right? So let's take that as a fundamental building block of what we're trying to do. So how are all the different ways that we can diversify ourselves? We can diversify ourselves across strategies, right? That's one dimension. We can diversify ourselves across time frames or parameter sets, right? And we can diversify ourselves across markets. So looking at those three dimensions of diversification, we can pick the optimal set of strategies and strategy families to make up our total basket.
I think it might be helpful if you could walk us through your strategy workflow, right? Like from how new strategies go from idea through to implementation. Would you be able to step us through that part of it?
From idea to implementation. Okay, let's see how to break this down. So first, obviously, we're going to have brainstorming ideation, right? So the most important part there is we are hypothesis-based models, not data mining. So a lot of us here have trading experience, or we have other teams to lean on for ideation, people who specialize in different areas or came from the physical. We can talk about, some idea they have, right? And from that idea, we start to do research. We will start to say, okay, there is something we want to capture. Say that's a trend. Okay, we know trends exist in this market. If they exist, how can we go about capturing them? And so that's where the modeling takes place. Then we want to say, okay, we have modeled it. How well is that model capturing that phenomenon? So how good is this trading strategy good at capturing that trend, right? Once we have implemented that, then we want to say, okay, from the retail side of things, everyone's looking for the perfect parameter, right? Everyone's looking for the optimizing on the best parameter set and saying, hey, this, EMA at 29 and, that, Bollinger Band at 32 or, whatever, find this best strategy's best parameter. I don't believe in that, because I think if you're capturing a specific phenomenon, that phenomenon is also, it's fluid. It's not stationary. So you're going to have different phases. So there might be short-term trends, there might be medium-term trends, there might be long-term trends. If I'm good at capturing trends, I should also be good at capturing trends over different time frames. Or this idea should be good at capturing them across these time frames. So I'm going to cast a larger net, right? I'm going to throw a big net out there, and I'm going to say, okay, how does this trend following strategy follow? And so I would make a family of them. I make a family of all these different parameter sets. And then I'm going to treat that family as one unit. We'll say trend following strategy unit. So I might have very fast trends all the way to very slow trends. And then I'll be looking at all of them and see how to mix them, over different periods, right? So I'm rebalancing them. I'm looking at rebalancing my portfolio, using different mixes of these things, because at that point, each one of these things is now no longer a strategy. They're all a return time series. They're all an instrument. I can now invest in any of this family of strategies as if it's a stock or it's a future. I'll say, hey, this one looks good. I'm going to put money into it. I just went and long the strategy because I've invested money into it, right? So that's how I'm looking at that. Once I've come up with whatever my portfolio is of these strategies, and we've done our, back testing with our in-house software, then we're looking at, simulation trading, implementing that, doing some, exchange-based small money trading, looking to see what any edge cases, what do we need to do, and then ramping that up to full-on investment.
Okay, so right at the beginning of that answer, you said that you focus on hypothesis-based strategies over data mining strategies. Would you mind just explaining the difference between those two?
Sure. So a hypothesis-based strategy development means I'm coming from a research or a human idea. Like I said, I believe trends exist. So how could I go about catching trends? Or I believe value investing works, or companies can be fairly valued, so I'm going to go about researching that. Data mining would be, okay, I've got 200 terabytes of tick data for 100 different markets. I'm going to run as much regressions and machine learning algorithms, support vector machines, whatever you want to run on it, and say, okay, now I have some model that looks like it's going to work. So one is coming from a much more human analysis, experiential research side, and one is a lot more data crunching, and I would say much more opaque, because if I start doing all these optimizations, machine learning algorithms, it becomes less and less clear what the underlying logic or what the underlying phenomenon I'm trying to capture. It just looks like something works, something is working. So that is the differential.
Yeah, no, that's a good explanation. And do you see, listening to your answer there, it kind of sounds like you're not a fan of the data mining approach. Do you feel as though it can work and some people do make it work, or do you feel as though it's dangerous territory?
No, I do believe it works. I have used it before, but there is like a voodoo line. Okay, there is a line where you start to do too much of it. It just becomes magic voodoo where the computer is spitting out some glorious answer. For me, it's always about unraveling it. I personally, as a human being, as a scientist, engineer, researcher, I want to understand what it is we're doing. Once it becomes so opaque that I can't unravel the logic, I can't unravel what is going on, or I can't easily do it and it becomes, overly complicated and unintuitive, I get uncomfortable. So I would say up to like supervised learning is probably okay. Classification is probably okay. But once you start to go like random forest, deep learning, the kind of reinforcement learning where it gets very, very deep and you can't, there's things that are going back into the system and it's evolving so much that you can't take a step back and open the box. Once it gets to that point where I cannot open the box, that's where I call it voodoo magic,
Okay. Very good. Also, in your answer there, you talked about you want to know how well is this model capturing the trend or the phenomena. So how do you measure that? How do you know how well that's working?
Right. So actually, I generate simulated data. I start with simulation data. And we'll just keep going with the trend following method because I think everyone's comfortable with it. And, I'm a big fan of trend following. So I can generate a synthetic data that has a certain amount of trend in it and a certain amount of noise. So I can set a signal to noise ratio and I can see what different parameters, this trading strategy, and how much noise can it take? How much trend does it require? And that way I can see, okay, in this, laboratory world, in this, clean room world, it can handle this. And then I can say, okay, I want to take synthetic data based on market data. And I can say, okay, is this still capturing what I believe it should capture? Which one of these, is catching, trends? Are the trends existing? Is the correlation between these two things high? And if so, then it is capturing something. And then we can take it to real data and start to backtest, because Chinese historical data is quite limited. Some of our contracts have less than 2 years of data. So I've got to be extremely, extremely careful on how much data I use. So we developed these synthetic methods, and it actually gave us ability to control things in a much more precisely tuned manner than just backtesting on live market data, because that is always going to have some component of noise, and that noise will be changing and you can't identify it. But when I put in exactly, 20% white noise, I know it's exactly 20%. I know exactly how much it's capturing, and I know exactly how much that's affecting my system's ability to capture that, we'll say, perfect, sine wave trend, or that perfect triangular wave trend. Those are the two types of waves that we use to check for trend following. Either, a triangle wave is like very sharp at the top, and then down, and a sine wave would be more smooth. So I can create different types of trends, different types of noise, different types of these types of things, and see how they're all performing in a very, clean and controllable environment.
Okay, so 2 questions. What is synthetic data, and why do you not just go straight to historical price data? I know you mentioned there that in China, there's only 2 years for some contracts that you'd want to test on. So you've got to be very careful that doesn't straight away become in-sample data. But I feel as though there's probably another reason for this as well.
Right. So synthetic data is data you generate yourself. So I will generate a random, time series or price chart, just, use the random number generator in Excel. That is synthetic data. You just generated, 10 years of data using a random number generator. What we have done is used that in such a way that allows us to control certain parameters. So it's much like before you, have any drug, right, released from a pharmaceutical company, you're going to have different testing methods. You're going to go through these different regimes. You're going to want to have very controlled environment. I want to do that with my trading strategy. I want to control the environment that it's released into. I don't want to just throw it straight into market environment, because there might be some confounding factors in the market environment that affect the strategy, but I'm not able to unravel why that's occurring. But in the laboratory environment, where I can generate these synthetic trends and synthetic noise or synthetic mean reversion, I can control everything. So I can see, okay, this much, additional noise reduces the profit of this trend following strategy by this much. But in the market data, if I say it's 2008 to 2009 or 2009 to 2010 or any given year, that's what I can change. But I don't know how much noise was added, how much trend each year had specifically, right? And each market is going to be affected by different factors each year. So it's not as easy to determine the exact, cause and effect that I can discover using synthetic data.
Okay. It's very interesting. I'm completely new to this idea of synthetic data. I've never heard about that sort of approach or read about it before. So that's certainly something I'm going to be looking into a little deeper. How many strategies are you trading today at the fund? You spoke a little earlier about how the first quant fund you worked at was juggling between 300 strategies. What's it look like at your fund?
Yes, actually, we have quite a much smaller number of strategies here. We just started this year, so we're only looking, at about a handful of strategies. But we're actually in development right now to launch a brand new family of strategies coming out. So it's a little bit less.
Okay, well, that makes sense. You're only new. So I really want to dig into this a little more about mixing strategies together. So let's just start with the basics. What are the benefits of trading a mixture of strategies?
Okay, I want to preface this with a concept that I think is really, really important. Once a strategy is made, do not think of it as a strategy anymore. Think of it as a time series or something you can invest in. It is now a security, a stock, a future, or whatever you're trading. And that P&L line, that is the price line that you're going to be trading. When you consider the P&Ls or the return series of these strategies in that manner, it makes much more sense to use diversification, because if I'm going to diversify stocks and they have their price lines, why shouldn't I diversify strategies if they also have price lines? So I think a lot of people treat their strategy, whatever that P&L is like something sacred. It's different than the market. No, it is a market. It is generating a P&L or a price line that you either want to be invested in or you don't want to be invested in, or somewhere in between. And how is investing in that, going long that strategy, going to help the performance that I'm trying to achieve? So is investing in this strategy going to help me reach my overall objective? Is that going to, whatever that objective may be? And if so, can I mix more of them together to, reduce my drawdown, decrease my volatility, decrease the amount of internal correlation I have, decrease the amount of any effect any large market shock is going to give me? I mean, there's tons of benefits, and it really increases your return, risk-adjusted return. So for us, it's not about absolute return, it's about risk-adjusted return, because if you can increase your risk-adjusted return, I can always add more capital or more leverage. So as long as I can manage that, it becomes one of the best tools you can do to easily increase your risk-adjusted returns.
Okay, then. And what are the most important considerations when combining strategies?
Well, I would say correlation is probably the most important between mixing strategies. Also, conceptually, why are you mixing them? Don't just, use some, portfolio optimizer and just finding specific values. I mean, we do that, but you want to have some logic to it. So like I said, we divide our strategies into different families. We are looking to bring these families in because they contribute in different ways, right? I don't want to just, have all of one type and none of another. I want to say for the Chinese market, I want to have a lot more divergent strategies than I have convergent strategies, because the Chinese market is a divergent market. So I can start with this kind of logical step. Then I want to say have some objective criteria that I want to, optimize against, whether that, increasing risk-adjusted returns, decreasing my drawdown, increasing my Sharpe ratio, whatever that may be, and take my correlation into account. So I want to say, okay, if I mix these together, what is the optimal mix of these types of strategies or these strategy families that will, hit whatever that target is, which is usually, risk-adjusted returns.
Okay, so when you talk about correlation as an important factor to consider when combining strategies, do you want correlation between your strategies, or do you want them to be uncorrelated as much as possible?
Uncorrelated as much as possible, just like you would want your stock portfolio to be as low correlation as possible. You want your system strategies to be as uncorrelated as possible. You also want that will probably also lead to their drawdowns occurring at different times, so then they can neutralize each other much better, right?
Exactly. Yes. I know you said that once you sort of deploy a strategy, you like to think about it as not being a strategy. With that being said, though, when do you decide when to actually add new and retire older strategies? Is that something you do in regard to the retiring older strategies?
Yes, absolutely. So we do evaluations every quarter. And we also take that time to re-optimize our weights or do, new back testing and checking with the simulation and the real trades. And there's looking at, is this portfolio what we want to continue with? Is it working? And that is all automated. So we have our criteria. It's just re-optimizing, distributing new weights to these strategies on a quarterly basis. Now, with retiring old strategies, if they no longer fit that criteria or they're no longer giving us good risk-adjusted returns, their weights will be reduced. And if they lose a lot of money or they start losing money, the optimal allocation will be zero, right? So eventually it will retire. But there's another part I want to overlay on that. There's a risk overlay or a supervisory overlay where we're monitoring that on a daily basis, where we use statistical process control to see if these strategies are continuing to act as they should. So one is a performance-based, one is seeing, is this doing the job it's supposed to be doing? So the strategy can be turned off from either of those situations.
Okay. Now, that's a really good answer. And what software, programs and languages, etc., are you using to do all of this? Like everything we've sort of been discussing over the last, half an hour when we've been talking about the actual strategy part of it. What are you using?
So we mostly use R, Python, C++.
Okay, so it's all sort of stuff that you've custom developed?
Yes.
Okay, so you don't use any sort of, or very little third-party software?
I don't use any third-party retail software, but we do leverage a lot of open source. I mean, there's a lot of great open source out there in the R community, like QuantStrat, Performance Analytics, and in Python, they've got Quantopia, and they've got the zipline backtest. We don't use that, but I'm just, for example, there's a lot of different great packages out there. So actually, we do use the Anaconda SciPy Python stack, and that's a great open source resource for us that allows us to build on that, and then all of our other infrastructure, back testing, risk control, execution is all tied up in our own in-house software.